Now you guys should be able to see.
Yep. Risk management.
Yep. Yeah, Ted, I purposely did do this when I put it on the schedule for now, and I was hoping we'd have a busy week. Remember, when I was trying to find a time to do this, I'd originally planned the Scalpathon for this week at the end of April, with the week with NFP. And then when this opportunity came up for an FOMC and NFP week for a Scalpathon, I thought, okay, I got to really make it happen now. And so kind of had a feeling that some people would get enlightening experiences from the week. Okay, everybody, come on in. We're just kind of chatting and taking questions and whatnot for a couple of minutes until everybody that was on time. Thank you. A couple of people are running a little late. I want to just give maybe no more time now. I just wanted to give a little more time to see if people were going to show up live because it's important. Let's go ahead and get started. Okay, so today is basically part 2 of what we did last Saturday, which, you were all there or you watched the recording. It's hard to explain kind of what we do from a risk management point of view until you've done it. And it's kind of good that a couple of people got run over this week because that's what should happen. This was a tough week. So this is a really, really important topic. And one of the tricky parts about teaching this topic is that everybody has preconceived notions of how this works. And remember what we said, tabula rasa, really important that you try to keep an open mind and just focus on this idea and this approach. And, it makes sense or it doesn't. But combining with other approaches is always kind of a bad idea because things don't mix together well, particularly in risk management. Risk management has to be a really clear decision for you. I put up the Investopedia definition here because I think it's reasonably accurate. But how do you do it is the hard part, not what is it, So anyway, now what I'm intending to do, I actually feel pretty good considering what happened yesterday, and I ought to be able to stay reasonably focused and get this through. The intention of the material, and so, I'm telling you this so you can help me stay on track if I don't. What I want to do is go through the risk management techniques that I use for this, and there's 3 of them, and then explain some of that and take questions on it because it's kind of tricky to understand at the beginning, and I hear people are still coming in, so I'm glad I delayed the start just a little bit. If you're just coming in, come on in. We're running a little later because people are coming in late, but we really want to get going. So anyway, I'm just doing the introduction right now. So we're going to talk about 3 different approaches, and we're going to talk about how they work and why they work, basically. And then I'm going to try to integrate the idea of risk management to the different setups that I trade. And I promised you last week I would do that, but I couldn't explain the setups last week until you saw some live trading and understood what we're doing and some of the different ways we do it. And unfortunately, missing the opening session yesterday, I had a few things I was hoping to get done before today, but life happens, and that's an important lesson as a full-time trader. Your life happens and you have to have life around your trading, but managing your life as a trader is tricky. It's different than having a job. We've talked about this before. The number one risk management decision you have to understand about trading is that trading is the only business where you can go to work all day, and come home with less money than you went to work with in the morning. And you have to respect that. Another way to put that, and you hear this all the time from experts, and this is one of the things I totally agree with, you can be profitable for a year, consistently executing, taking profits, managing risk. One day where you lose focus, you can blow that entire profit and then some. Yeah, I've seen people blow 5 years of good work in one trade. I've done it. I told you this. I started trading in 1973, and in when would that have been? It would have been in 1979. I threw away about 75% of what I'd made over those few years, and it was a lot of money. It was 6 figures. So that happens. We all are stupid. We're human. So no worries about being late. Just try to be on time, guys, if you can. And anyway, we're just starting, so we have a decent crowd here. Not as many as I'd like to get of our total. A little less than half, but that's better than nothing. Anyway. So another one's coming in. Okay, so let's go on. I'm going to wait just a second for that person to get in the room before I say the next sentence here. Okay, cool. Let's proceed. So that's a basic definition, but I really want you to understand that this is not something you add on to your trading edge. This is the most critical piece of your trading edge. If you can't manage risk, it doesn't matter how good you are at anything else. It literally doesn't matter because you'll blow up anything that you do positive. Any profits you make, you'll give them back. This is a critical topic, and most people do not pay enough attention to it. So let's talk about it, and let's talk about the approach that you should take, in my opinion and from my experience, which is what I'll always tell you. And you know what? There are people that don't agree with what I'm about to tell you. Although, let me qualify that by saying I don't know very many people that would disagree with what I'm about to tell you that trade the futures actively during the day. Investors will disagree with some of the things I'm going to tell you. But short-term future speculators, which is what we are, most of them that have any experience would not understand this approach necessarily, but once I explained it, they would understand it and they would agree with it. So, again, I'm going to poke some fun at some traditional risk management approaches because I just don't understand how anyone could think that way in a market like we trade. It looks great on paper, but it never works. So let's proceed. By the way, for this session to be valuable for you, please interact with me as much as possible. I am on a reasonably large amount of drug for treating my infection and a tiny, tiny bit of antihistamines and some other things that cloud my focus a little bit. I'm not taking anything beyond that, but if you have questions, tell me. If you get something, interact. It will be helpful for all of us. Also, let's see. I'll make that next point in just a minute. So, okay, let's get going. Why isn't my slide going to the next slide? Okay, so before I get started, a couple of people drifted in at the end. I want to do just a tiny bit of free Q&A. I try to do this when we're live trading, it's not as important, but when we've had theoretical sessions, before I start a new one, I always like to say, is there anything we've done this week or did last weekend that doesn't make sense or that you didn't understand or that you have a question about? So if there is, let's get those out of the way first, then we can just focus on today's topic and questions related to that. So I don't see anything getting spun up in the chat, so let's assume the answer is no and we'll move on. Okay, first thing, if you have, let me rephrase this. I was about to say if you haven't, let me rephrase this. Is there anyone here who has not watched Risk Management 1 through 3? Because if you haven't, it will affect how I present this material. So I'm assuming everybody has. Don't be embarrassed, but are there any if there's a large number of people that haven't, then I'm going to have to review it. But is there anybody that hasn't watched those 3 videos? You can tell me privately, or you can tell JVC if you don't want to tell me, but I just want to know. I'm assuming everybody has. Okay, looks like they have. Good. This is one of those things when you're in front of people, you can just look in their eyes and you know the answer, but I can't do that visually. Okay.
And it won't help you if you're just too embarrassed to say. This is for your benefit. So there's no shame. Just make sure you let us know.
Yeah, absolutely. That's such a good point, JVC. I'm not doing it to punish people. If you didn't watch those 3, the stuff I'm about to explain won't make any sense at all. But the term swarming won't make any sense. The math idea of it, how I arrived at it, what tools were used. I'm going to do like a 2-minute review of that, but I need to understand how deep that review should be. Wait a minute, I have a message or two. Okay, all right. So a couple of people haven't watched them all. Okay, so thank you. That's helpful, everybody. I got a few private messages and there's a couple to everybody. Okay, cool. All right, so go back and watch them afterward, those of you that haven't, and I'm going to try to be a little bit repetitive as I explain some of this stuff, but I'm not going to go into the real deep math kind of thing. Let me just explain the following. Risk management in real life, like you're trading your cash account, there's good tactics for risk management, but the bottom line is you can do it any way you want. I mentioned I have this friend who's one of the guys on the hedge fund call and used to be one of my trading partners, and he's a trust fund baby in Beijing. He's got $1 billion trust fund, so he can afford to be wasteful with money while he's learning. He doesn't, but he can, and so his risk management could be very different with his cash account than, say, mine or yours, where, $100,000 loss might be significant. To him, that's an interest payment for a week. It's insignificant. So risk management is relative. It's very relative. And that's critical thing number one. Number two, and let's get, let me review some of the things I talked about in the 3 videos. First of all, the number one thing you have to do in risk management, and this is what most people just don't do, is they have to assume the worst case. I paused for a second. I was trying to find the spotlight thing I didn't want to animate this slide. I figured I'd just throw the whole thing up here. There we go. So I'm on this bullet point right here. So the first thing you have to do is you have to assume the worst case and then game that. That's thinking in bets. So let's talk about this for a second. This is why people get run over. They do not do this. How do you do this? Okay, let's give some examples. And this goes back to how I developed swarming. When the whole idea of Top Step and the risk and the evaluators, and some people call them prop firms, they're really not, but these combine firms, it started with Top Step. They were the first one. I tried really, really hard to be a principal investor in Top Step and couldn't get in on the offering. It was such a good idea, and I know the guys there real well. And there was no way to do in the market what they created, where you could try out. Combine is a term from the NFL, National Football League, to try out for American football. So that idea was very interesting because it was a way you could teach people to manage risk and give them the chance to win a real account and to trade for real money, So the part that most people don't understand about that whole space, and now it's obviously grown quite a bit, and I'm going somewhere with this, is that the tests are designed for you to fail. Top Step has their two-part thing. And, I won't go into that, but let's just talk about the more conventional approach with the trailing drawdown. Even a good trader, Lee likes to point this out, a good trader who makes $100 a day, if you have a couple of losing days in a row, you hit the drawdown. And on a $1,500 account is the one I'm using. That's the 25,000, which it isn't. 1,500, let's call it that. So their entire business is about the fact that people don't understand how to manage risk. That's the entire space. So I've been playing around in it, again, just to tell you the rest of the story, since Top Step, and I've tried all the evaluators out. It's mostly market research. I don't need their money, but it's fun to get, to be able to. I just qualified for one at Lilu, so I've got a $9,000 target now going forward. It was a $150. So I've got $5,000 of drawdown that I just bought for $180. And that's insane. That takes a leveraged market and it gives you more leverage, which is great and no risk. It's not my money. I can blow it up. It doesn't matter. So how not to blow it up? Well, second part of the story, and again, I'm reviewing some of the stuff in the videos, but it's important for you to know this. I'm just doing it fast so we're all on the same page this morning, including me. So I have a friend who runs a fund, and the primary thing they do in their fund is they game technical analysis levels because there's so many retail traders that use them, and a lot of professional investors use them, quote unquote support resistance, crossovers, MACD, RSI, all that garbage. What he did it's 2023. So he did this like 15 years ago. He went and raised a bunch of money after proving that if you get a bunch of smart mathematicians together and you game the levels, fibs or another one, or Elliott waves, if you game those levels, and game has a very specific meaning here, if you statistically analyze the probability of things happening and then try to push it. Because if you're big enough, you can do that. So let's say we're at a really strong resistance level. A large fund can push it just a few ticks above and get the stops triggered. And that's what this fund does. And there are many that do this. This is just one I know of. It's a friend of mine. Okay. To do that well, he has a tool that they use on their trading. It's an optimization tool. And basically what it does, and I don't own this code. I can't run the code. I can't run your stuff on the code. He's a friend, and once a year as a birthday present, he lets me run my data against it. And so that happened a couple of years ago, and we ran this whole space with the rules of these evaluators and the objectives and the profit and loss, the target versus the drawdown. And a couple of interesting conclusions came out of it. Number one, the only one that makes any sense whatsoever is the $1,500 drawdown, because it's at least 1-to-1. After that, you have to really focus to pass anything larger than that because of the way it's edged against you. And you have to do it by staying really small in size. But once you have done that, what is the math of that? And that's what we ran through the model. And what it turned out was that because of the trailing drawdown, number one, you have to take profits really fast. So scalpers are automatically have an advantage in these evaluations because, we don't try to let trades work. We either take profits or we don't, at least if we're executing well. That's what we do. Okay, so that was the first thing. But the second thing was, and this is a really sophisticated model that was written by a bunch of MIT math PhDs that he has working for him. That's his shop. It's a bunch of math geeks with PhDs. I mean, I'm not kidding. And he came back and said, you know what? And I ran this by my programmers too, and they agreed with the result. And I said, okay, what is it? He said, there's no way to win this game over time unless, so he said that first, full stop. He said, there's only one exception to that. If you play the extremes, because that's where the risk management is in your favor. There's no other place, there's no other tactics you can use with this trailing drawdown approach and not be at risk of blowing it up at any given moment if you're managing a trade correctly. So the only solution to that is to downsize and go really slow while they collect their fees, and that's their business. So it's really important to understand that. So his model came back and said, yep, that's the story, but here's a way you could beat that. And so I got very interested, and the rest of it, quote unquote, is history. We developed the swarming model, and then a year later, we refined the swarming model. And now I'm doing it very, very successfully. And so it's one of the things I'm going to teach, but I really want you to understand that it's kind of a unique approach to playing extremes. And you can be a really good scalper and never use swarming. It's just, when you use it in the right place, the results are ridiculously productive. And if you understand where not to use it, then you're okay. And that's the hard part, is where not to use it. So yeah, exactly. JVC just, you know what? Here's a good exercise. JVC, can you just repeat the Lee example for everybody? Because maybe another voice will help put it. Sure. Put it strongly in their minds. Go ahead.
Sure. I'm actually, I'm trying to remember exactly what the winning amount was. Was it $100 or
it's $100? Yeah. Or $100 or 150. Yeah. It's
100. Yeah, I was trying to remember. It's like 100 or 150. Anyway, whatever it is, the math works out with a trade. And actually, let me back up a second. In case any of you don't know what a trailing drawdown is, I'm so used to that term, I shouldn't assume everybody understands that. The idea of a trailing drawdown is, let's say that you start your evaluation out, you're at flat, you're at break even, you're at you have your $50,000 account, whatever nonsense, but whatever, it's that. And let's say you make $1,000, so now you're at $51,000. And then let's say you get in another trade and, it goes up $500. So now you're at $51,500 and you protect it at a tick, and then you let it come back and it takes your stop and you get one tick. But you're thinking, well, I didn't lose any money. I'm still at $51,005 or whatever. Well, no, you're not, because what you've done is you've allowed your trailing drawdown to go up to 51,500 and come back down again. That's the trailing part. It comes back down and tightens up. So you've just given up $500 worth of your available drawdown in doing that, but you didn't have a loss. Right? That's the key to understand here. You didn't lose anything, but you did lose something. You lost trailing drawdown. That's one of the reasons, from a marketing standpoint, why these companies, they talk about these accounts as being 50,000, 25,000, 150,000. No, they're not. But if you stay fixated on the account balance number, you're going to miss the trailing drawdown. You're not going to notice it. You're not going to think about it. Yep. It's all about the trailing drawdown. That's all that matters. And so the math works out with a trailing drawdown. You could have a $150 trade, $150 winning trade that you first let go further to 500 or whatever. And then it comes back and you get 150, and it comes back and you get 150. The next one goes up and comes back and you get 100, and you never lose. You have a $150 winner over and over and over and over and over, and boom, you just blew up.
Yep. Every one of those brings the trailing drawdown up by $350.
Yep. But you don't realize it because you're not thinking in terms of trailing drawdown. And that is the only thing you absolutely positively must never, ever, ever, ever lose sight of in evaluations. If nothing else, I mean, there's lots of things you shouldn't lose sight of, but the one thing that if you lose sight of it, you're dead is the trailing drawdown. And that's by design. That's totally intentional. They know this. This is why the math is what it is for exactly that reason. It is because people are going to blow up.
Yep, that's exactly. And you've got it exactly right, Ted. So the answer to that, no matter what your setups or tactics are, is you have to take profits when you have them. You can't say, well, I'll just, as long as it stays above break even. No. And that's why you see me do what I do, where what's the most important thing to do when a trade goes on is switch your mind from how much money can I make to risk management. And then as soon as you've made that switch in your mind, the second that trade is profitable, protect it. Because the worst case is you get out with a little profit and your trailing drawdown isn't affected. But if you let that puppy go up, and let's say it pops up and you're plus 300 and you say, oh, wow, I could get to plus 3,000. And then it comes down and you take $100 profit. You just raised your trailing drawdown. You cannot do that. You have to be relentless in taking profits. That's why I have 3 rules of scalping or of my trading. These go back 40 years. They have nothing to do with the evals, but they're perfect for this. Number 1, good trades work right away. Sitting in a trade, it's probably not going to work. You guys saw an example of that this week with me. Always take profits and protect them as fast as you possibly can. And no big losers, because a scalping edge is about repetition. And it's lots of little winners. Every now and then you will catch a really big winner. And if you did that by protecting it on the way up, it won't hurt your trailing drawdown because you took the full profit. And that's a key point to remember. Protecting your trade is critical. Yeah, that is, and that also keeps you from getting run over. There's a reverse of the protecting your trade psychology, which I also want to throw in here, because I made a decision not to do it, but I said I was making the decision not to do it in a trade that I blew up last week. If you recall, it got back to roughly break even. And when it did it, it started to go profitable. And at that moment on a trade that had been against me, the right answer would have been to get flat. But I mentioned that and I said, but let's go ahead and keep this running and see what can happen. And then I ended up having to flatten it out like 17 points higher up. And it ended up going 57 points higher up. So I got out of the way at the right time. So I showed you an example of that, how, even if you make a bad decision, sometimes you can fix it a little bit later on, but you have to be relentless in that mentality that you're protecting yourself from risk, not, well, I could get profitable. And that's really important. So did I develop swarming because of the evaluators? Well, yes and no. I've always been a very aggressive fader of ranges. That's a consistently successful tactic for decades for me because it's just the nature of futures. They have rubber bands. Oil, I used to trade oil really aggressively, and I traded YM really aggressively about a decade ago. By aggressively, I mean 100 lots. In the YM, not the micro. And oil, I used to trade up to 30, 40 contracts sometimes, CL, not MCL. So, that's a lot of money at risk. And the tactic that I started developing there was this idea of a rubber band snapping back into the range, because most of my work has been about interpreting the range. That's what the LRCs are all about. And that's why I use the standard deviations of the volume. The more angles I can have on the range that come from different pieces of information in the traded volume, the better. And, the VWAP is a very significant traded volume tool. Therefore, the standard deviations of that are useful, as have we got far enough. The LRCs are just pure raw statistical price action with no consideration for the volume other than how it affects the price. In other words, that approach to the range is totally adaptive. And that's really, really important. That's why it works so well. So anyway, let's, there we go. Okay, my mouse disappeared again. So let's move on. And again, this topic, we're going to spend a lot of time on this, and we'll stay here as long as we need to get it clear. Don't think that you get this and, why isn't he going faster? Because this is critical stuff for you to understand. So let me repeat a couple of examples that I've said in the past in the risk management classes and whatnot. But one of them that just happened recently, risk management in life. I think the whole idea of thinking in bets, which I know you've all read by now, the whole idea of that is really, it's a good life philosophy, and it's my life philosophy. For example, yesterday I went through that as I got worse and my fever went up, and I had to start thinking, okay, do I teach and go to the doctor later? That could kill me. That's probably a risk I shouldn't take. So I think I ought to go to the doctor. Here's another example of that. I just moved up here from Cambria, up here into Washington State, Cambria, California. And I'm a minimalist. I don't own a lot of stuff, and I like to kind of do things myself. So, I rented a little 10-foot van and a trailer to throw my 20-year-old Mercedes on, and I packed up the van with all my computers and a few other things. I don't own furniture or anything like that. I always just get it wherever I'm going. And so it's relatively easy to do that. Computers are the hardest part. It takes a couple of days to break the office down and pack it well. And so I started driving up, and it turned out it was in the middle of a blizzard that I had delayed my drive for a couple of days already to try to avoid, but I couldn't delay any farther. And the blizzard kept getting worse. So anyway, long story short, I went up the coast. I tried to go around it, stay away from the mountains. And then finally, when I got into middle of Oregon, I had no choice. I was at, I'm blanking on the name of the town that I was in, but anyway, a famous little college town on Interstate 5 Grants Pass, before we go up into the mountains. And I was there. I stopped for fuel. I was smart. I fueled up all the way. I knew that pass had been trouble. There were people that had been a couple of days earlier that had been stuck up there for days, before even help could get to them. And so, I knew all the risks. I talked to the other drivers in the gas station. I talked to the clerks. And I thought, well, I could stay in Grants Pass or I can try to drive it. And right now the road's open. It looks okay. If I stay here and the big storm that's about 3 hours behind me comes in, I'm going to spend the next 2 weeks in a hotel in Grants Pass, which I may not want to do. So, but I'm driving a moving van. It's not exactly the best vehicle. I didn't have chains on it. It was a big deal to try to put them on, and they weren't required yet on this pass. They were saying really recommended, but if the road's open, we're escorting people through, So anyway, I went for it. And long story short, as soon as I did, there was an accident in front of me, and I got stuck on that road for almost 4 hours. And fortunately, I was full of fuel, and I had some food and water. But again, that decision I could have gotten stuck in the middle of nowhere, and there was people in a car next to me that ran out of fuel while we were waiting for the road to reopen. And and they couldn't run the heater in the car, and they were literally freezing to death. They had to get in a truck that was behind me and warm up with the trucker in his cab. So, sometimes a seemingly small decision can end up having massive consequences. And this occurs throughout life. And so I just want to make a point here, because as you think about trading, think about it in terms of life. And, a little decision like that can end up being catastrophic. And you see that all the time. But you can't avoid risk. You have to take it, particularly if you're a person who does things that are risky. So you have to balance that equation. And the only way to balance that equation, in my view, without overly being emotional, is to think in bets. What are the odds something can happen? How catastrophic is it? And you have to go from there. So let's talk about how to do that with respect to trading and with these risk models. So first, R to R. I have to always address this because it's so stunningly stupid, and people do it anyway. So what's R to R? R to R is this common nonsense. It's a metric for the past. That's the right way to use R to R. Risk to reward is what R to R is. You see traders constantly posting, yeah, I just got long and the R to R is 3.1 to 1. Nonsense. Okay, R to R, what they're doing there is they're saying, well, where my stop is, that's my risk. Also nonsense. And that because stops get run over frequently in the futures market. And then the other way, particularly in thin futures markets, your stop is a order that when it gets hit, it becomes a market order. But a market order can be executed I'll give you live examples. I've had market orders that were stops, even in liquid instruments like CL, execute 10 points away from the trade because the market was moving so fast. And you have no other choice. You can't make a market order. Well, you can make a stop as a limit, but then it just won't fill. So this happens all the time. So the whole idea that that's my risk where my stop is nonsense. Your risk is what's the worst thing that could happen. So we'll come back to that. And then your reward is a target that's artificial. It's something that you figured out that, well, if it gets to there, I'll make X amount of money. the market doesn't care where your target is. The market will give you whatever the market feels like giving you at any moment. And you have to be, particularly as a scalper, you have to be willing to accept whatever the market gives you. So whatever you do, forget this R to R stuff. It is just completely wrong. And again, in scalping, R to R is often massively negative for the reason that I'm going to talk about in 2 more points here, asymmetry. So we'll get to that. But don't think this way. Yeah, people even sell indicators that, if you put on a trade, it calculates the R to R. Who cares? The market doesn't care. And if I go back and look at my profitable history, which is decades of it, the R to R was rarely favorable unless I'm swing trading. And even then, I never calculated, but if I go back and look at it, based on the past where I entered, where I exited, where my that trade is wrong. So how should you do it if you're not going to do that? Well, the thing you have to do is you have to figure out what the worst case is. That's really what your risk is. What's the worst case? So how do you do that? Well, you've got to think in true worst case scenarios. So for example, how many of you remember a few years ago, and it's getting to be more than a few years ago now, but in the last decade, let me put it that way, there was a flash crash in the financial markets, and the markets dropped a ridiculous amount and then rebounded, and this happened in seconds. Does anybody remember that? Do you guys remember that? 2010? Okay. There's actually been a few of them, but that was one of them, absolutely. Does anybody else remember flash crashes, or are you all newer than that? Yes. Okay, cool. So this is a case where the market is going one way with so much momentum that, let's say your stop is at, and this was a true story. This is how it worked out. I'll just make up the numbers to give you, an idea. Let's say your stop was in the S&P 500, ES at 2,500, just for an example, okay? There were people that had stops at 2,500 that were filled at 1,500, okay? That's catastrophe. That's what can happen. That's what catastrophic risk looks like. Yeah, the documentary, good example there. And you know what? The thing that people think, well, the laws will protect me, or well, that has to be insured, isn't it? No, nothing in our market is insured. Yeah, there's some catastrophic stuff going on. Brokers go out of business. I remember there was a big broker that went belly up because they were mixing client funds. This was back in the 2000s, and one of my friends had a couple $1 million with that broker. It was a very prominent, well-known broker, and some of you probably remember this too. And ultimately, he got about 90% of his money back, but it took over a decade for that to happen. And sometimes it doesn't happen at all. So understand, you really need to have a risk. You need to have an appropriate respect for the risk you're taking. So what is the worst case in a trade, and how can you figure that out? Well, again, it depends on the instrument, and it depends on the certain conditions. But let's just say, that there's no flash crashes, and let's just say the market's normal volatility, or the kind of volatility we had last week. Then how do you do this? How do you figure out, well, what's the worst thing that could happen to me, and how can I game that? And the answer is relatively simple. And this is what my friend helped me figure out, and we have since refined quite a bit, is a couple of different risk models, and I'm going to talk about them. But it's important to understand that never take catastrophic risk unless you mean to. And there's times when it's appropriate to take catastrophic risk. A good example of that would be if you have a Lilu bundle and you get 5 tries at something. You can literally take catastrophic risk 4 times in a row and not on the 5th time. So there are times it's appropriate. In my funded accounts, there are moments where if the market is really asymmetric, and we're going to get to that in a minute, where I will put on a big enough trade that if it goes really wrong, it will blow up that funded account. But again, the funded account really isn't $5,000 or $3,000. That funded account really is the $180 it cost me to get there. So that's all I'm risking. And I'm not risking $50,000 or $150,000 like they like you to think. So again, very important to get your mind right in this concept. And that's why I'm approaching it the way I am. So let me talk about the 3 risk models real fast. But before I do that, I want to just, I'm not sure if my slides got screwed up here, so just give me a second just to pause this. I think I made a slide this morning and not saved it in the right place. Yeah, that's what I did. Okay, that's fine. So again, I apologize if I'm a little bit off on some of my stuff. It's just because of my hospital experience. And I promise you the material will still be of value. But now I can't find the darn toolbar again to turn the share back on. There we go. Okay. So, share. Okay. There we go. You should see my screen again.
Yep, we do.
Okay, cool. All right. So the first thing you need to understand catastrophic risk is this. What is the dollar value of movement in the market you're trading? It's very different in different markets. And, most traders that are in the futures market at least understand this, but they don't understand the difference in how things move relative to this. So let's talk about that for a minute. Let's need to get the spotlight back on here. Okay. So, we all know the ES pretty well. It's $12.50 a tick, right? $50 a point. There's 4 ticks per point. And if you're trading the micro version of that, it just divide by 10, right? So that's a relatively simple thing to do, right? $12.50, $1.25. So the only difference in those is the commissions, obviously, and I'm not going to discuss commissions for that. That's just a cost of doing business. But it's important to understand whatever instrument you're trading, you need to understand this to calculate the catastrophic risk. So let's look at it from the NASDAQ point of view, since we're trading primarily in this class anyway, the NQ and MNQ. But again, the whole idea applies to anything. So the NASDAQ tick is $5, right? So there are 4 ticks in a point. So a point is what? Anybody? I'm just seeing if anyone's awake. There we go. Thank you. Okay. So that's what a point is if you're trading that. So if the setup, this is how you do the catastrophic risk. If I'm looking, let's take a quick example in our heads. And by the way, I'm not doing this with a bunch of slides and showing you the math, because you have to get used to doing this in your head. If you can't set up a spreadsheet to do this. You won't have time to look at it. You just have to learn it. Okay. So if it's $5 a tick or $20 a point for NQ, and I'm trading a very typical setup, like it's at 92 and it's going up, and I think I might want to fade 20 because I like doing that, but typically it will give us a pullback right after 0.0. So for each one of those scenarios, what I need to be able to do real quickly is calculate the catastrophic risk. So for example, if I'm at 92, I always just think in terms of blocks of $10, of 10 points, okay, 10 points of NQ. So you all just said a point is $20. So 10 points is, anybody? Okay, exactly. So if that's the case, okay, every time it goes that far, that's what it's going to cost me. This is something I know very clearly. Okay. And obviously you have to adapt this to whatever instrument you trade, but you have to have this math memorized. So if you are trading 50 micros, that's 5 minis equivalent. Okay. How much risk are you taking? If you're trading 50, how much risk are you taking per point? Is he right? I want to see, what do you guys think? How much are you taking per point if you're trading 50 micros? The 10 point, okay, good. All right, everybody's on the same page. Okay, I just wanted to make sure you guys are following along. All right, so this is the first thing you have to be able to do in your head. Now, if you have a $1,500 drawdown and you're putting on trades that could cost you $200 to $1,000, guess what? You're taking too much risk, because you cannot afford to make a mistake if you do that. You make 1 or 2 mistakes and you never can recover unless you're just ridiculously good after that. So this is important to just have the broad amount of dollars versus points thing going on in your head. Okay, now let's go back to the previous slide if I can do that, and it doesn't want to do that. Okay, this is the same problem I just had. There we go. Okay, sorry about that. Normally I do that stuff really well, but again, I'm a little foggy this morning because of the last 24 hours. So let's go back to, whoops. Oh, I see. Okay, it's on because my mouse program is for my trading platform. That's why it's not working. Okay. All right. So understand the catastrophic risk, first of all. If you're going to take it, make sure you intend to. Now, the market will always go farther than you think, and stops can get run. So how do you do that? Well, there's a couple of different ways that I understand that. And to do that, I'm going to hop out of this for a second so I can show you some chart views. In the very short term, I look at the nearest inflection points on the 5-second view. So this is ES. Let's grab NQ just because it'll probably be a more interesting view of this. Yeah. So, forget the LRCs for a moment. That's about the range. Let's say I was looking to, let me find you a good example. Okay. Let's say I was, for some reason, looking to short this move up. Okay. Which, at certain times of the day, it's actually an interesting setup. That was interesting spot there. Okay. Let's say that it was after that spot and it's starting to show some weakness here. So this would be a really good example. So it's taken out the initial balance, didn't get all that far above it, and then it starts to show a little bit of weakness. It starts making lower highs and lower lows. So let's say I was looking to short this, maybe just thinking, oh, maybe it'll go back to the top of the initial balance. That's a very common trade. And sure enough, it did. It did right there. So maybe that's the trade I was looking for. So if I'm looking at this exact situation, how do I figure out the catastrophic risk? Well, and there's a couple of quick chunks to it, okay? The first chunk I do is I just look at the recent trade and I say, well, where's the recent high? It's right there. So if I'm looking to fade here, let's say I was at 69 and the recent high is 76. So again, NQ likes to overrun areas. So if I looked at that, I might say, all right, 76, maybe I'll give that to 82 and then I'm wrong. Okay, so I would let that go, but not very far because, you had a reasonably strong trend up until that point. But up here, as I like to say, we are no longer trending up. We trended up pretty nicely off the open, but then we went into ebb and flow at the high, see? And that's often a good sign of a place to fade. So you have to assess the risk of that, though, because clearly you're going against the grain, at least, the trend, if there is one. So the first place I look there, and then I put a little bit of slippage into the decision. So I might to 82, maybe 10 points in there. So if I'm short here, 10 points above the recent high, call it 90, maybe that's the worst case. How much money would that cost me? This is the first decision I make. I'm not looking at, God, that could be a good entry. I could make a lot of money. I'm looking at this. I'm saying, if I'm wrong, how much money could it cost me to be wrong? That's my risk. Being right's easy. Being wrong is what gets expensive. So you have to get good at being wrong, right? Correct? So if I look at that scenario, let's say I'm trading a one lot. Okay, we just did the math for that. $20 a point, and let's say this might be 10 points. So it's about a $200 risk here to get short. Now, if you're doing R to R, you say, well, my risk is $200, and this could go all the way to the other end of the range. That was where that's a reasonable spot if it starts down where it would stop. But this is a more reasonable one first. So we have about 40 points to a first potential target, and a whole lot more if this market truly is done going up, okay? So if I look at that and I use R to R, it looks really like a great trade. My God, I could make thousands and I'm only risking 200. And that's the problem with this entire R to R nonsense, is it doesn't take into account the setup at all. It doesn't game it against what's going on. And the market was going up here. So that's the wrong way to do it, okay? You need to look at the total risk, but you don't look at it against the reward. You look at it, and this is the key point, you look at it against the information you have as to whether you are right or wrong. That's what asymmetry means. So let's go back to the slide for a second. Let me minimize this and put my slide back up. I'll just leave it there rather than making it full screen, okay? So this is why asymmetry is so important. There's two kinds of risk here, and it's important to understand them. They're different. One of them is the risk of losing money, and we really clearly can see what that is. That is very gameable. And I keep using this term gameable. What do I mean when I say gameable? Gameable is really simple. Gameable just means, can I use statistical analysis to figure out what the odds are? In other words, can I think in bets about this topic? Okay? You got that? So asymmetry is critical because when I'm doing that trade that I just showed you, let me put it back up here. When I'm doing that trade, I don't know if it's going to go up or down from here. Pretending I do based on the trend, or pretending I do based on structure, or pretending I do based on the traded volume or the volume profile or anything else is wrong, because those things are not telling me if I'm right or wrong. They're just telling me what's going on right now. The only decision that is in front of me right now that is absolute is how much money I could risk if it goes against me. There's no debate about that. That's clear, okay? So I have to understand that amount, and then I have to weigh it against the other thing, which is information. Now, information here is really clear. I don't know what's going to happen, but I do know really clearly where I'm wrong. So the decision here is totally asymmetric. If I'm right, it's really obvious and the potential is huge. If I'm wrong, I know exactly what the risk is and I know exactly where I'm wrong. And for those of you that got run over last week, it's because you didn't do this before you started trying to swarm into ledges. You'd started doing it after you were swarming in and you already figured out, oh crap, this is going against me. You can't do it that way. You've got to look at it beforehand. So if I'm considering a swarm, and I'm going to explain this more in just a minute, but let's say I'm considering a swarm of 50 contracts, okay? Where do I plan to add them? What will it make my ultimate risk be if it totally goes against me? That's the catastrophic risk number. I have to take that into account first. Then, if that number doesn't work, there's no trade here. Even if I think I could execute profitably, it doesn't work from a risk management point of view. Therefore, I shouldn't do it. Okay, let's see. I see a question. In this case for you, you go out if price goes to 90. Let me see what. The example that I was describing, yes, I was saying, well, where am I wrong? Okay, well, I'm not wrong at 90. Let me try to get this as clear as I can make it. The high here is about 77. And so what I do is I look at that and I say, okay, if it got significantly above this, I'm probably wrong, or at least I'm way too early in this idea. So what could it look like up there? I don't use 77 as the number. I say, well, if 77 goes, it's going to do what it always does. It's going to spike up and go by a lot more because that's just NQ. And so, and you know, all indexes will do that because stops get run when you get to a spot like that. So in NQ, if you watch it, you know, religiously over the course of a few years, it has a habit of going 10 to 20 points when that happens. It almost always goes 10 points when that happens. Sometimes it'll only go 5. So there's less risk than you thought, but I use 10 as a minimum. So I'm looking at that 77 and I'm saying, what's the nearest inflection point in NQ? And the answer is the low 80s, because the low 80s is the spot it likes to either decide it's going to 0-0 or it starts running out of gas. And if it gets above the low 90s, it is going to break 0-0. There's no question about it. And it'll probably get as high as 7. That's the statistics of the way NQ moves. And I know that because I've traded so much. So if I saw that, I'd look at this and say, well, my risk is at least 82, not 77 or 78, because that level would likely blow. And it might blow all the way up to 90, but I could probably get out, even if I had some slippage, somewhere in the mid 80s. So that's what I do. I use 10 points. And there are days when that's not enough, but it becomes pretty obvious when we're breaking ledges and they're screaming. You know, I've seen NQ go 40 points on a ledge break. So, you know, it could go from that 77 there and end up, you know, at 20 above. I've seen that happen. It's rare that it does that under these conditions, but it does happen. That's what short squeeze days look like. Okay, so that's what you have to do. And that has to be the first thing you do. And the problem with this is if people do it at all, it's the last thing they do after they're already in the trade. Now, let me stop here for a second and ask you guys, how many of you have done that where you start swarming or scaling into a ledge or a fade idea and you don't start thinking about the total risk until you're already in the position? You can be honest, because we've all done that. I do it sometimes. Of course. Yeah, yes. That's why you blow up. Now, you'll still blow up if you do the catastrophic risk calculation, but because if you've done it right, it will be rare. And when you do blow up, you'll say, well, that's fine. I meant to do that. And there's a couple of cases where I didn't really do it in the Scalpathon, but if you were trading with me at all in my live sessions the week before, I did in a public sessions a couple of times where I was doing a Lilu bundle and I said, okay, I'm going to get really aggressive here and let this blow up. If it doesn't work, why not? Because it's a YOLO. You just go for it because you got 4 more of them, and every now and then that's fun to do. And if it works, great. Just don't burn that into your brain that that's how it's done, because it's not. You're doing that because you have 5 tries to get it right. So if your odds are good, if you're at a good inflection point, 1 out of 5, you should be able to pull it off, right? So that's the thing. I know you guys are struggling with this. I know you are, and I'm going to get into a lot more detail. So I just want to introduce these concepts because they're alien to a lot of people. My risk isn't, where I should put my stop. No, your risk is catastrophic risk where the spot that you have a stop or you would exit gets overrun and you have to chase it and you get slippage. That's your catastrophic risk. So the only place to really get aggressive is when you can manage the risk very asymmetrically. In other words, you can't manage the dollars any better than knowing what they are. But if you get to a level, again, if you get to like an SD4, yeah, we can go through them. And yes, we can sit at SD4 for a while. But the odds are much more likely it's going to work there than it's going to work at SD1 if the market's trending. So let's look at a couple of examples of this. And then I'm going to go into some of the mechanics and some other tools. And we may end up having to extend this and do another session next week. And that's fine if we do. It's a good concept. It's a good discussion for that because it's stuff. I know that this is the thing that screws everybody up. I know that because it screwed me up. I get it. And when I coach people, I see it in them. I'm seeing it right now. So don't worry, we will address this. And you are, yeah, okay, that's a good point, Samuel. So I'm really good at where to put those limit orders. That's why I don't get filled when we're at extremes. And I understand, the kind of personality is the right word of NQ and MNQ, because I've been doing nothing but those 2 contracts for the last, nothing at all for the last, most of this year. And then last year, I spent a lot of time testing ES and MES against NQ and MNQ. And that's the other thing. If you watch the risk management 1, 2, and 3 videos that I mentioned, my friend and I, with his model, we tested that. And in every single case, without exception, if you take the exact same setup in ES, MES, NQ, MNQ, it is better to trade it in MNQ or NQ. The exact same situation. The simple reason is the NQ in the same, if we have a 1% move, NQ will move around and overextend a 1% move more than ES will because it's so thin. It's not as liquid. The same is true of SCL. Hell, CL can move 7% in a day and then go back to 0. I've seen it do it. It's insane. So it was important to add that as a second piece of the risk management analysis was that when you trade an instrument, does it give you the opportunity when it's asymmetric to capitalize on it? And for example, Maria trades RTY instead of NQ and ES. And there's a good reason. Back in the workshop, we talked about this a lot. RTY has virtually no algorithms in it. It's too thin. But it almost perfectly follows from a pattern point of view, the volume profile pattern, not the whether it's up or down or just the shape of ES. It's uncanny, and nobody can explain why that is. I've watched this do this for 2 decades, but it does do it. It's accepted fact by people that know RTY and the Russell. So it's a huge edge to avoid this problem of being able to get profits. In ES, the problem with this approach is that there are so many algorithms that are working, 3-tick strategies where, somebody will sell to buy or buy to sell. And so that ends up making your gaming of the movement harder to execute. You don't get as much movement per setup. Does this make sense? This is a really important point why this technique works the best with thinner instruments that are still liquid, though. I wouldn't try this with like something really thin, like some of the commodities, but it works really good with active liquid instruments. And the more volatile ones, it works better with. Even if you're trading the structure of ES, if you execute an NQ, you'll get better trades. And that's does anybody not understand that point? It's a really important point. And then we're going to continue and talk about the techniques and some more about asymmetry and the setups. And then we're going to talk about the 3 risk models. That's coming up. But I'm going to take a quick break beforehand. So I just want to stop here and make sure everybody is on the same page with me. If it seems like it's going slow to you, it is by definition and by intention. You have to marry the concepts I'm saying before anything I'm going to say next makes any sense whatsoever. I promise you. It doesn't look like it makes sense until you understand the things I've said up until this point. Let's see. Jeff, in the catastrophic risk example, lack of correlation between ES and NQ. Absolutely, that is totally true. So if we have a day that's not correlated, particularly if it's not correlated for a simple reason, like, the day YM wasn't correlated was because Goldman was down and everything else was up, or the day that NQ is not correlated because Tesla's down and everything else is up. When that happens, your edge is gone, because our edge relies on that. So when you're seeing that, you either have to factor that into what you're doing and trade accordingly, or you have to sit it out when we don't have good correlation. I actually like the lack of correlation because I'm good at arbitrage, which is the Goldman situation. I traded the YM that day because Goldman didn't recover right away, but it started to later in the day. And therefore, all I had to do was buy YM because Goldman's recovering, and it's the only thing down in the YM. So I can't not make money as long as Goldman doesn't turn back down. So that's what I did. I put a stop on Goldman that closed out my EF position, or excuse me, my NQ position. One more time, my YM position, and I left the trade running, and it was a really nice, profitable trade that I didn't even have to manage. As long as I didn't get a pullback in Goldman, it would leave the YM trade on. It's a simple little strategy to write in 2 seconds in even NinjaTrader, and it worked great. I had a beautiful runner that I never even watched. So there's an edge there, but you're absolutely right. If you don't have the correlation, your risk increases because guess what? Your information is not as accurate. Normally at a ledge, when all 4 indexes are ledging and going up, we know that's strong. But what if we're at all 4 ledges and the only one breaking its ledge is NQ? Everything else is in the range. That happened several times last week, and that was the absolute best place to fade NQ because it was getting overextended because there was a couple of strong. It was Microsoft earnings in one case. You get the point. So that's why it's so important to understand not just what an index is doing instantaneously or over the course of the session. That's what this is over here, right? How much it's changed on the session is there. The domes are showing me the instantaneous correlation, but it's important to look at that in terms of, well, is something pulling an index up or down? Remember this exact same situation, but there was one day Tesla was just bright red. It was down like 12%. Everybody else was up, and the NASDAQ didn't do well because of that. So it was very gameable. Again, there's that word. If you can calculate odds, or like you just said, Alfredo, perfectly correct, if you can figure out the odds are not as good as they might be for one reason or another, what you're doing is what I tell you an experienced trader starts to do. You start using your tools not to figure out where to trade, but where to tell you when you're wrong. That's the purpose of your tools. And you nailed that. Correlation is critical. If you don't have it, be careful. You hear Lee say the same thing. It means that there's an anomaly in the market, whatever that might be. Goldman out of sync, Tesla out of sync, or it could be something completely different. Maybe funds are liquidating tech or they're buying tech. We saw that a few weeks ago. The whole market was flat except for tech, and tech was just ridiculously strong and never pulled back. Why? Because it was the end of the quarter and everybody was getting out of everything and getting back in tech. So of course, that there's reasons, but first you have to figure out what's happening. The reasons aren't as important. How it affects your risk is what's important. Okay, I'm going to take just a quick break here for a few minutes. We're right at the halfway point, so this is perfect. If you have other questions, by all means, please get them in the chat for me. We'll talk to them. Otherwise, we're going to come back in a few minutes. I'm going to put this over here where we are. I've got the spotlight back up. I'm going to go refresh my coffee, do a biology break. All right. So let's put things back and then we can continue our conversation here. All right, so spotlight will not stay on. I don't get that. Okay, it's on. No, it's not on. Okay. Settings, spotlight. Still not on. That's so weird. There it is. Okay. All right. Cool. Okay, let's continue. So, asymmetry, risk versus your information risk. We talked about, the beauty of ledges and edges of ranges. If you're in the middle of the session, is that you have a really clear idea where you're wrong. So therefore, it's easy to do this calculation. On the other hand, if the range is really big or the ranges are not statistically valid, then you need to not use this method. Why? Because the method isn't going to work, because you don't have statistics to back it up. So let's look at a couple of examples of that. If you have, normally when the market is in the middle of the day, if you look at my LRCs, they'll look like that. And, the other ones inside might be doing this or that. But, pretty much we have a horizontal range. Okay, that's a normal, session, middle of the session kind of behavior. What else do we get? Well, when we're trending, and again, this is all in the videos, the 3 videos, but I'm reviewing key points here. When the market is trending strongly, what you'll see the LRCs do with respect to the range is they'll be parallel, because on all time frames, statistically, the same thing is happening, that we're making higher highs and higher lows, and we're doing it in such a way that on all time frames, you can see the pattern. That's what that means. And that's a pretty consistent trend. That doesn't mean you can't short it, but you need it to go into ebb and flow before you do. And I just showed an example of that. Otherwise, you cannot try to use any of these risk management techniques against it, because you're wrong. You should not be trying to fade a trend that's that strong. So this is an important point. Ideally, what you want to trade, if you're going to do these kinds of things, is you want to see it look like this. And then on the shorter term ones, maybe they look like that. And then the ones at the top are like that, or even like that. That's an example of a pause at the extreme of a recent range. And okay, where am I wrong? Up here, plus or minus a little bit. So what else can I learn about this spot that's valuable? I know it's the edge of the range. That's a given. I know ranges are useful to statistically scalp, but they're not perfect. Ranges get broken all the time. How does a range get broken? A range gets broken when new information comes into the market. New information can be somebody buying or selling. New information can be news, and everybody jumps out of the way, and the market gets real thin. Anything can happen. So if I'm at a spot like this that I'm considering a trade, either a long or a short, which are both a valid idea here, because it might be about to blow this way, in which case I want to get long and go with it. I do that. I don't do it as much as fading, because fading works faster. If you're going to join a breakout, you've got to be really tactical about where you try to do it. And you either have to kind of do it right here and, protect yourself on the way to the idea. That's kind of how Lee does it. The other thing is to assume it's going to go, and, you can get in right here, but put a target right there. So as soon as it breaks it, you're out profitably. Those are all legitimate ways to play the edge of a range. But what about getting more information about what that spot means? You can do that too. You just have to know how to do it. So let's talk about that. Okay. What are some ways to do that? Well, the simplest one is to look at standard deviations of the VWAP, because the VWAP is the volume weighted average price. And in general, we don't get too far away from it. So these are the weeklies, and you can see where those extremes are. So noteworthy, on Friday, we never even got to SD1. We just had strength that was within the weekly normal, because SD1 to SD minus 1 is normal. That's the weekly normal. We didn't even leave that range. Now, if you looked at this on a daily view, it would be very different. And I do have that here. Let's compare it real quick. It's just, this is set up for real-time data, so I got to adjust it real quick. So let's see, I just need to go to 1 day, 1 minute. That'll give us, so this will give us what Friday looked like. And we can see a comparison to that, because obviously the extreme of any given day is going to be very different than the extreme of the week. So here's Friday, and on the daily extremes, we got, guess what, right to SD2. And that's where the market decided it had gone far enough. It did the same thing here, but it went into ebb and flow and never really went back much, which is the same thing it did here. But it ultimately got to SD1. How did that happen? Because the VWAP came up. It's not because the market was so extreme. The volume was going with the price. If you're going to look to fade extremes, you don't want the volume going with it. You want to do it when the volume is not going with it. You will get a much better trade. So that is an example. And again, I put this in the criteria for swarming the edge or for trading the edge of a ledge in general. But if you're going to swarm it particularly, you really got to be mindful of this. Trying to do this in a trend can really get you in trouble. And if you're going to try it, you really got to wait till it's much more extreme than it was Friday. Friday was not extreme at all. Again, I have to emphasize that point. But if you look at the previous week, this exact same price level was a significant extreme of that week. Do you see the difference, guys? This is such an important point. This you could fade. And yeah, it overshot that level, but it went all the way back down there. This one didn't even try to pull back because this was an extreme. This wasn't. And that, again, what I'm doing when I'm looking at this is I'm gathering more information. That's that asymmetry. I know the dollar risk. We just did that a minute ago. Figure out the worst case scenario, add all the contracts to it that you might be tempted to add. Where would you do it? Add that all together. Do it in your head really quickly. If you have a total of 20 on and you're offsides by 20 points on all of it, and more than that on some of it, how much money is it going to cost? You can afford to take that risk. If not, don't do the trade. Do this before you start the trade. Do not start a trade and then start thinking that way. It's too late. Get flat. You're gonna make a bad decision. I promise you. Okay. So that's one form of have we gone far enough? What are some other forms? How about structure? Structure is really useful. If we put in a high and there's no unfinished business and it price rejectors, which this didn't quite do, this one did though. If it does that and it trades back into the range, there's a pretty good chance that that's asymmetric. It's a spot that, and also look at that. That happened to be max delta, which is also a sign that that's where passive, what? Quiz question. Big delta means passive who are at that price? Likely. What does it mean? Passive who? What are the passives doing there at that price if it's selling? Exactly. Those are the passive sellers. If they're there and they're big, that probably gives us some element of not protection, but understanding of the risk if we're wrong. There's enough of a pushback there. It'd be better if it was a price rejector, but the fact that it was a clean top with no unfinished business and it traded aggressive, every period after that traded back into the range. So that was a good spot. And I'm looking at half hours here. You could do the same thing and look at, 5 minutes. There's no right, all time frames are wrong. You're just trying to get a sense of, has the market gone far enough? Well, you got to go look. And let's look at that same spot, only let's look at it on this view. Well, we had a beautiful price rejector right there on the 5 minute. And then we had another one shortly after that, So again, you can always find a time frame that supports your opinion. That's not what we're doing here. What we're doing is we're saying, is there anything relevant here that gives us more information? And yeah, if there was unfinished business up there, then our risk is higher of fading it because we know it's probably not gone far enough. Now it might not revisit that for a month, but it's still noteworthy as an extreme, as a have we gone far enough? Just like I'm basically looking at 3 of those. I'm looking at the very, very fast with the LRCs. I'm looking at volume-based, how far have we gone? Is it far enough? Is it extreme? Based on the VWAP and the standard deviations of that. Again, when you're doing that, it's critical to pay attention to what the VWAP is doing. Because if it's coming up too, then you're really not as extreme as you think you are, or if it's going down too. And we had a trend down day not too long ago. It was just the exact opposite. Everything went the other way. Okay, so what you're trying to do, and the reason it's asymmetric, is if you quickly look at all those things, and what's another one? How about the internals? Again, I've got this set for intraday. Let's go back and look. Was this a day that I should have avoided being short on? Well, it gapped up and never looked back. I mean, we opened with 1900 advanced decline positive and we never went down. And that's a very strong number there. It's not quite as strong as it gets, but it's pretty close. Same thing with NQ advanced decline. Look at that. We opened at plus 40 and we got as high as plus 91 out of 100. And we closed at 85 out of 100 were up. So that's a pretty strong indication that there's a bid under the market. So does that help you with your information? Absolutely. The risk is the same because all you're focused on for the risk is the dollars and what catastrophic. Look, if you've already accepted that if the worst case happens, it's not the end of the day, then that trade is worth doing. If you look at that worst case scenario, that risk, and you say, wow, I can't afford to lose $1,500 on this idea. Guess what? It's a bad idea. Never look at how much money you can make. Always focus on your asymmetry, which is the information you have that's really good here. But we don't know if it's going to be right. We're just thinking in bets. And the more information that's supportive of our decision, the better. The less quality of the hand. Remember ace kings, pair of aces versus a pair of tens, pair of jacks. Okay. If everything says, yeah, that's a really good spot to fade, you've got an ace king. Was this an ace king to fade Friday? No fracking way. Advanced decline was way too strong. The tick almost never went below zero all day. It was positive all day. A couple of times it tested down and immediately reversed. Same thing here in NQ. The market just did not want to go down. And on Fridays, that's very common. Again, we'll have next Friday to trade this, and I'm sure we'll have some more fun then. But does everybody understand where we're going here? So dollar risk is math, and you have to do it first. Once you've done it, you know what it is. Make sure you factor in any scaling you might do in and out. And again, it takes a little practice, but don't try to do this with a spreadsheet. Get good at doing it in your head. You don't have time to do this in a spreadsheet. Your brain has to be programmed this way. And it's easy to, I don't care if you're horrible in arithmetic. This isn't complicated math. And I'm going to show you some examples in just a minute because we're about to go to the 3 risk management models. And I will get to that next. Okay, let's minimize that. Okay, do I still need this here for the moment? Let's put that back over there. Everything is kind of all moved around here. So where's my ES one? It's here too. Put that back. Okay. So let's draw a little bit and let's talk about the 3 different models for risk. So, and I use the setup, the ledge setup, because it's the easiest to trade and it's the most gameable. So that's what we'll talk about. But this applies to ranges as well. So let's just say we have a normal bell-shaped curve day with good excess at the high and the low. And so, and the VWAP is in the middle, or roughly in the middle. So, and so that would, this kind of a layout on any given day would put SD1 typically right here and here. It would put SD2 right about there. And then the ledge would typically be between 2 and 3. That's a typical setup for a day. That's how it looks when we're not trending. And this is, the ideal place to try to do what I'm about to explain. Okay, so that's kind of where that stuff is. Let's get another color here. And okay, so 3 different ways that I can trade this. And let's say what I want to do is I want to fade ledge breaks here. And it might not get all the way up there. It's a pretty orderly day. So I'm going to say, you know what, maybe I'll play a little bit. And let me mark these. So this is the VWAP right there. And this is number 1, +1. This is -1. And this is -2. And this is +2. Okay. So these are just extremes of the volume. And again, it's important that we're doing this on a day that has a very normal balanced approach. That's when you want to do it the most aggressively. When you don't have balance, then, it gets trickier. It's doable, but it gets trickier because there's more variables, okay? So let's say we're looking at this ledge up here, and I'm going to get yet another color for your visual entertainment. Okay, so 3 different ways I can approach this. The simplest one, and again, this is the result of my friend and I analyzing a couple of years of my trades and then taking those trades, the results of the trade and what it was that I was trying to do, the setup. And I keep really accurate records on this stuff. I have a giant if you're familiar with Access or SQL, I have a giant SQL database, SQL database, that literally every trade I've ever done is in it. And I just offload from my platforms. And that enables me to find patterns in my behavior and patterns in the markets that I trade. And this was one of the things that came out. When I'm talking to my friend and we're running my data against the model, and it comes back and it says, well, you know what? The only logical way to play with the evaluators is under this setup. When we're up here somewhere, and we have not a trend day. Okay, so we're at some sort of statistical extremes, and it's not a trend day. And if the other factors are supportive, the structure and the internals and the indexes components, then all the better. Those are things that add to or take away from the quality of the setup, but they are not the setup itself. The internals won't tell me where to trade, but they'll tell me whether it's a good idea or not here, right? Okay, so let's say I want to short this, but I'm not totally confident that it's not going to keep going up. We're up here. Let's say we're trading right here. And, it could go higher, but it looks like it's probably going to go back into the range. But, at the time of day or whatever, maybe I could be wrong, Okay, so first thing I'm going to do is I'm going to say, well, what's wrong? Well, it's, pretty far above this. Let's say wrong is up here, okay? And at that spot, I've got $200 of risk. Okay, for the position size I'm looking at. Here's how I might execute what I call a 1+1 strategy. So this is the risk management approach of 1+1. And here's where this came from. My buddy's computer came back to me, and it's like magic computer on the wall. Tell me things that are important. And the first thing that it came back with was, you cannot do this with one entry. Because of the way trailing drawdown works, and because of the way these indexes move, particularly NQ and MNQ and CL and YM, the ones that move around a lot. If you try to do this with one lots and you're right or you're wrong, you'll be wrong all the time because it's too volatile. The conditions are too volatile. You will not be able to take one entry and be good enough with one entry that the odds are good that every time you do one entry, you can make money, even if your edge is good, because it's just impossible to be that precise with any one entry. So again, if you take a mini and you say, well, if I do one NQ, that's X amount of risk. We just talked about that. It's $20 a point. But if I do micros and I break it up, I have 10 tries to get the same position on, and my risk is roughly the same, a little bit higher because of the commissions, but it's much more manageable. It's much more executable because I have 10 possible entries. And let's say, I put on the first one and I'm way too early, and then I put on a couple more, and now it's starting to be at the right spot. And then I get the full 10 on, and that's not adding to a loser. It's gaming this situation. The problem with it is, if you're not good at that, scaling aggressively as it gets more extreme can get you run over, as many of you did. So how do you not get run over? Well, try this first. Get good at 1+1s. A 1+1 is very simple. It's not always one contract. It's one increment and then another increment. I trade a minimum of 5 micros. So when I do a 1+1, this particular setup, I would be short here 5 micros. I would say, okay, that's a good setup, because the odds are overwhelming when we have this kind of a volume profile that I can at least get back to here. And that's usually a very profitable trade. If I can get a little bit more size on, I could take some of it off there, and I probably can get back to here too, because that's just the nature of value on a day like this. So if it gets up to, again, if a rubber band stretches just a little bit above the ledge to up here, and I can get more on up there, then let's say at this point I add 10 more. So this is now minus 15, okay? What I've done is I've put the spot that I need to be profitable really close to where it's overwhelmingly likely to be profitable. But again, if I'm going to do that, I have to take the total amount. In this case, it's 20 now, with 20 contracts. And let's assume that I'm scaling myself up to 1 mini or 10 micros here. That's what I'm doing. So do the math. How much damage can I do if it aggressively goes above here? That's the risk. Now, I don't do R to R, but if I did do it and I looked at it getting back to here, it would be favorable. But again, with scalping, what you're really doing is you're just looking for it to get from here to here, and then maybe here. And if I can protect it, maybe here. And see what I mean? So you're playing the odds of that point, not how big a winner you get if you get here. But you have to have already accepted that if you go above here, then you're going to take the loss, and the loss isn't the end of the world. It shouldn't even be distracting to you. You should be able to just go on to the next trade without worrying about it. So that's the calculation you have to do. So if you're doing a 1+1, you don't do this, where you scale more aggressively. That is what you do when you're swarming. A 1+1 is kind of like training wheels for swarming. And let me explain how it works, because it's a lot less damaging and it's better practice. So let's get rid of this. And let's just say we were not swarming this, but we're 1+1ing this. So again, it's not one contract. It's you just take the same number. So if I like this here, and I'm going to put 5 on short, and it blows the ledge, and like maybe that's 5 points, maybe that's 10 points, and then that's a really strong spot. Maybe that's SD3. Maybe it's just above the recent high where there was really good price rejector, or just below it. NQ likes to overrun those. ES not as much, but that's the spot. What I'll do there is I add the exact same amount. That's why I call it 1+1. So this is -5 and -5. I'm drawing with my mouse. So if I'm trading one contract, I add one more. If I'm short 5, I'll short 5 more. If I'm short 10, I'll short 10 more. But generally with a 1+1, you don't want to do it with more than about a 5 micro position. And what you're doing is you're practicing your ability to scale into a good setup where you're temporarily off sides. That's the idea. So this is a 1+1. And the beauty of this is you never have a lot of contracts on, and when you're wrong, you're out. So you can't do a lot of damage here. Think about the math of it. You shouldn't be, if you're doing a 1+1 setup, and you're doing it properly with, say, 5 micros and 5 more micros, you shouldn't ever lose more than $100-$150. That's where I said that example where I use a circuit breaker if I'm trading like a $1,500 account, and I'll use a circuit breaker in Rhythmic of $150. It's this setup right here. If for some reason my platform crashes or whatever, it'll take me out. And this, I will never let a 1+1 go worse than that against me. It's just not worth it. If there was more potential there, I would be swarming it. I wouldn't be doing a 1+1. So this is a 1+1. It's always the same amount of contracts. Typically, you're going to do this when it maybe hasn't exceeded the ledge or the high yet, but it's the kind of day where it's maybe not likely to, but then it does, and then you really like that spot, and you can put on a little more. But, if it continues going up, then, something changed and you're wrong. That's the 1+1 setup. And again, let me just 1+1 is what that's called. Okay, very simple risk management technique, and it is the result of the analysis we did, my buddy and I, that says it's impossible to get a good entry with a one contract trade. His computer tried to do it over 3 years of data, and the conclusion was statistically it wasn't doable. Are you hearing me, guys? That this whole idea, well, you should never trade 2 contracts unless you can trade one profitably? Nonsense. Micros changed the game. Yeah, that's true if you're trading an NQ, because you can get in a lot of trouble with NQ quickly. But with micros, no, micros make it work. And so that was one of the other things that came back from the risk management tool. It said, under most circumstances, you should pay more commission and use micros, because let's say I'm doing a 50 micro trade versus a 5 lot NQ. Again, I have so much more flexibility and granularity as to where I take them on and off. That can make the difference for a trade that works and doesn't. Often with this kind of a scenario where you have a really strong, clear edge of the range or edge of the session, what you want to do is do trading around a core position. And the idea is to trade short up here, but take profits as it pulls back. And ideally, you scale more and more into a position that's getting you more and more favorably. And then, when it works its way ultimately back to value, you've got a big winner. That's what I like to do in these. But the thing you can do wrong doing this is start doing that kind of thinking when, in fact, conditions are changing and we are breaking out of the range and we're not likely to come back into the range. That's a different scenario. And again, I showed you some things that might tell you that's the scenario, like the tick or the advanced decline or the structural view or where the SDs are. There's a lot of ways you can look at that, but you have to have done that already. If you don't, then you're just going to, randomly pick spots to trade. And that's no good. There needs to be math behind your thinking. Okay, any questions about this before we move on to the small swarm or the baby swarm approach to risk management? I'll leave this up for just a minute while I wait because I'm going to draw a different looking volume profile because you don't want to swarm aggressively under certain circumstances. Okay, I don't see any questions. Cool. Let's go to baby swarming. Okay, so baby swarming is kind of the next level up of risk. You're taking more risk because you're scaling more aggressively, and that has to be justified. So your setup has to justify that, and all of the other things I talked about still come into account. You have to factor in your contextual pieces, but the bottom line is, does the price setup warrant it? That's the question, if it does or it doesn't. So first question, is the market strongly trending? If the market is strongly trending, don't try to swarm it. I put that on a whole bunch of materials that are in the Scalpathon stream. If we're swarming, it's just really silly to try to do this. You can make it work, but you're going to be off sides over and over again. That's why trends are so hard to trade, because going long with a trend works really good until the trend stops trending like it did at the end of Friday. And then again, you can be caught off sides, and the trailing drawdown will kill you if you try to trade that way because you're not taking profits. Remember, we talked about that at the beginning of the session. So trend days are almost bad enough to either stay away from completely or only fade them when they're really opportunistic to fade. Trying to join a trend on a trend day is really hard. However, on trend days, trend breaks of initial balance or the 15-minute range or the ledge, those are definitely long opportunities because they'll typically go for a while, particularly if they're taking stops out and really rocking and rolling, leaving zero prints, lots of aggression. Those are tradable with the momentum. Just understand that those events tend to reverse sharply, even on a trend day, and so it's tricky. All right. Let's talk about baby swarming and giant swarming, which are basically just 2 degrees of the same thing. But I divided them up. I used to have just one, big swarm, small swarm, or I had 1+1 and swarm. That was the first year. And then we went back to the model again. And the model came back with another interesting suggestion that, 1+1 is the minimum. You can't do this with one contract. Okay, we know that. And swarming makes sense because the more extreme it gets, the more aggressive you should be. That's statistically true. However, there's degrees of that, and it's a very significant difference between when you really want to get aggressive and when get really aggressive will really screw you like it would yesterday, okay? So you need to have 2 different approaches in your playbook to make that work, and you need to default to the first one, small swarm, but every now and then a small swarm can become a big one, if you can justify that, but you really have to think about the relative risk because the risk is much bigger when you start really scaling and it really goes against you. You just can't buy a pullback that will make the trade work. So let's talk about it. What are the ideal circumstances to try to do this approach, and what is this approach? Okay, ideally, what we have is a reasonably good high value area. Where's the value area? Where's the VWAP? Is there a significant amount of volume around it? But oftentimes on good swarming days, we'll have oddball patterns like the double D, where we have 2 of those and a big low volume area in the middle. That makes a swarm fade of here, if it's going this way, really good, even though we're not at a ledge. Because if a high volume node holds when there's 2 high volume nodes, the area in the middle is horrifically unstable. It's likely to go through there really fast because just nobody traded there. So if we get going this way, we're really likely to get to here. And likewise, if we're going this way, we're really likely to get to here. So when some of these oddball patterns allow you to scalp with swarming the middle of an event. But the ones that are, and those are doable, but they're harder because you got to learn to recognize ranges, and ranges are hard to learn to read. Ledges are much easier to read because there's the ledge. There's the ledge. It's really clear. Here, it's the edge of a range, but it's not a ledge with an L of the session. And those are, similar, but slightly different in an important way. Okay, so let me get another color here. I'm not keeping track of what colors I used before. So anyway, all right. So let's say we like this ledge. And on a day like this, you don't want to try to play right when you get to it because it's just a dangerous spot to play. What you need to have happen if you're going to do that is you need to see some degree of extremeness, and you need to see exhaustion, and you need to see a tail forming, particularly in NQ. So ideally, what you want to see is it doing this. So if this is the scale, you want to see the volume just diminish and diminish and diminish until it's just running out of gas. And ideally, it doesn't necessarily need to be doing it at both sides, but this is the kind of environment where swarming makes a lot of sense because of a very simple math rule that's true. The farther we get away from where all this volume is, the more likely it is that we'll at least try to go back that way. And again, if you're looking at the tick and the internals, and you're looking at the momentum, and you're looking about, if this is SD4 up here, okay, and the tick gets up there really strongly, and then when we get up there, it reverses, and we see advanced declines start to come down. All of those things are the kind of things that tell you, yep, that's the spot I want to play. So it reinforces that, and it gives you the difference between an ace-king suited or a pair of aces and the pair of tens. It tells you have a much better setup. You want to see a tail, this kind of exhaustion. If you're seeing that, then the idea of swarming this makes a lot of sense. So again, an abrupt edge, in other words, a poor or weak high, you don't want to swarm a poor weak high because it's really likely to revisit that and go higher. But this kind of setup where, it could go higher, but the further away it goes, the less likely it is to keep going. That's where we really want to play. So let's talk about how do you do that. Okay, so here's the math answer. And we've tested this extensively. I've tested it in actual live trading and my P&L that I posted. And this is why I now scaled up so much. And, you're seeing $10,000 days out of me with this approach instead of 6 months ago, it was $1,000 days because I'm using NQ more and less MNQ because I'm trading more size. I'm also doing it more aggressively. There's a lot of days I'm going all the way up to 150 micros because it justifies doing it. What are those conditions? Well, here's an example. Okay, it gets to here. Let's say that's on a day like this, that probably would be SD1, probably would look like that, but not necessarily. Those could be the initial balances, whatever. Let's say it gets above that level and it starts going into the area that exhausted. That's the kind of setup, particularly if it's slow up here. If it goes up sharply, you can always fade aggressively. But if this is like nibbling up, you got to be careful. It might be a good spot there. I could say, let's put 5 on there. 5 micros, -5, okay? And that might be a profitable trade. If it just pulls back to here, I'd take it right back off. And, you see me do that. That's my dome as an ATM, $20, $50. I did a bunch of those last week in our live sessions. Just, it's just really gameable in the short term. If it doesn't go up much more, it's really likely to go back and revisit the high volume node because that's why it's a high volume node. Real simple. And you can watch that in the order flow to help you see that's happening or not happening. That's why I'm looking at the traded volume. Is it trading on the bid or the ask? If it's up here and I want to put this trade on, which side do I want to see the volume trading on? Quiz question. Please put the answers in the chat. Do I want to see it on the bid or the ask if I want to fade this? Okay, come on, more people. I have one vote for ask. I have a vote for the bid. Wow. Okay. We need to go back to the theory then. The correct answer is the ask. I guess I need to explain this. Okay, if we're at a spot, and let's just say, this is the traded volume, and over here is on the bid side, and over here is the ask side. And I'm seeing, 100 over here, and 50 over here, and 25 over here. As I go up, it just gets more and more absorbed. These numbers gets bigger, okay? And the volume over here gets lower. Here maybe it's 0, and here maybe it was 5, and here maybe it was 10, okay? The buyers are running out of gas here, and there's ample absorption. So I want to see the volume on the ask side, guys, because that means that all the buyers are getting absorbed. Does everybody understand that? So, and what I want to see on the bid side is I want to see when the bid trades that it pushes the bid down. And I want to see that the ask is not getting lifted because the people selling can't lift it because there's not enough aggression from the buyers. This is critical. So you want to see the volume on the ask side at the highs, and you want to see the volume the other way around on the bid side at the lows. That means that at least for the moment, the people trading there are holding it. There's more holders than there is aggressors. So those of you that said the bid, it's you want to see it trade into the bid, but you want to see the bid getting slammed, which happens later. This is about just, if volume is trading into the ask and price is not going up, then real simply, for the moment, the every buyer is getting absorbed. That's absorption, okay? Exhaustion is the idea of the numbers just getting smaller as we go up. So it wouldn't look like this. If we were exhausting, it would look different. It would look like this. It would be, hang on here. And exhaustion and absorption is ideal. We don't get it that often, but that's the ideal. And that would be that, maybe there's 5 up here and, by 0. And maybe, this was 25 and this was, 2. And that's ideally what you want to see. The further up it goes, the smaller the numbers get. And that's exhaustion and absorption. And that's what a price rejector looks like. So just to be clear. Okay, I see a question. Let me get the question. So if VWAP is close to SD1, you avoid the trade. Well, it's not so much that I avoid it. Under the right circumstances, I might take it, like a really strong range day, but I would never take it aggressively because it's not extreme. SD1 and minus SD1 with the VWAP in the middle is basically the definition of agreed upon value. Until we get to some sort of extreme, SD2, we're getting to like 95, 96%. Okay, now we're starting to have at least a statistical basis for the extreme, right? So yeah, you could think that way, but don't make it that absolute. Okay, so again, for the swarming example here, the idea would be, oh crap, I didn't mean to erase. You know what, let's erase the whole thing. I'll draw a new picture. Okay, so here, let's do our swarming example again, and let's just detail it so you guys can understand, first of all, the pieces, and then, okay, how to execute against it. So let's say, let's just use a normal day and with really good extremes, and that looks like this. That's a normal day with good extremes. Just, VWAP's in the middle, really clear what's going on. We get up here, and, it just whittles down to 0. Okay, that's a good day for this technique. And that's the most common form we have of day right there. That's why it's a nice setup. We get lots of chances to play it. Okay, so this is a ledge up here. It might not get above here on any given moment. If it gets to here, we're at 95%. If it gets here and it breaks it, 99% it's going to break it. Once you get to a ledge in NQ, it'll at least break it by a tick or so. It just always does. There's rare exceptions to that. That's what I mean by the rubber band. But, the most it might break it for is 5 or 10 points. And then this, returning to here or returning to here becomes a massive opportunity because the likelihood, again, it's asymmetric. The likelihood when we get to here or here that we're going to at least come back to here is so significant that it's not even really worth calculating the chances it won't. Yes, it can happen, but the odds are so low that it will be a black swan, and it will happen while you're trading. And this will happen to you on days that are this orderly, but it's just so unlikely you can play it hard. How would you play it? Well, this is a baby swarm or a giant swarm, and the only difference is the level of scaling over what distance. So in this case, I might do -5 here. On this one, I might scale up or I might not. Again, it kind of depends. I might put 5 more on there. But the idea of a swarm is the farther away we go, the more extreme we get, the more aggressively I'm going to scale it because the odds it's going to come back in get higher and higher and higher because it just can't keep going forever. Even if there's aggressive buying, the people that are buying will take their foot off the gas and try to wait for a pullback. So, the setup has perfect math. It's just about executing against it. And when it's moving up really strongly, you take profits really aggressively. When we get one of these sharp, sudden breaks that reverses, those are the ones that, take a quick profit. And if you can put on a runner and protect it, by all means do it because, the odds are really good you're going to get to here or here. So what would that look like? Well, in my case, what I typically do is I'll do 5. And then here, I might do the same amount or I'll double it. So in this example, let's just say I do 10. And then up here, I would again add more. It might only be a double of that. It might be another 10. It could be 15 or 20. Again, the setup, it depends because I've already thought about the risk. I've thought about how many I want. Let's say I want 50 in this case. I'm not going to get all of them on or most of them on by here because for the 50, it's got to go above here. So what I might do is, okay, that's 15. Maybe we'll do 10 more here. Now I've got half of what I really want. And then if we get that explosive run the stops move and it goes up 10 more points, I'll hit the market up here and I will take 20 more. Okay. So maybe even 25 more. In fact, that's a better example. At that case, I probably would take 25, not 20, because I like to keep even numbers. It's just part of my OCD. So I'd probably do 25 more here. So at this case, okay, I'm short 25 and 25. So at this point, I'm short a total of 5 micros or 5 minis or 50 micros, right? So I've already figured out if it goes further up and I can't buy a pullback, I know how much that's going to cost me. And you should have the math in your head. That's 5 times 20. Okay, that's what it costs for every point above here. And that could get ugly, right? Anybody not understand this? Okay. Now here's the beauty of this. When you've done, again, you're not adding to a loser. The odds at this spot were 99% that we were done going up. And a short little burp above that, that's a stops run is perfect. Because when you do that, if it just comes back to here, you're profitable. That's your break even now. And odds are overwhelmingly high it will get to here because of the asymmetry. And now you've got a really profitable trade. As long as you can stomach this risk if it goes against you. And this is where you're all making mistakes. You haven't done that calculation before you tried to put this trade on. Now, the only difference between a baby swarm and a giant swarm, I do baby swarms generally up to 5 or 10 micros. And so I'll do it, like with 1 at a time or 2 at a time. Lately, I haven't done very many baby swarms. If the trade is legitimate for a swarm, I'll either 1+1 it and scalp it really fast and, take 4 ticks profit and get right back out. I'll do that if I'm, for example, counter trend scalping. But if it's a legitimately good swarming setup, and this is it, take a picture of this screen. This is what a good swarming setup looks like. Because when you have no volume up here, the odds are overwhelmingly good that it will trade back into volume. Let's look for a couple of examples of that, just so you guys can follow what I mean. Like Friday, when Friday was just a trend up, there was no pullback. Exactly. That was a really hard one to short. And you should have immediately said, by looking at the internals and by looking at the price action, that this is trending at least right until the end of the day. It stopped trending at the end of the day, which is common. That it was just a mistake to try to fade it. And like I said earlier, in my view, trend days are too hard to trade altogether. I generally just take them off because it's too hard to get and stay long with the trend day, and you're going to get run over if you try to fade it. It just, go skiing. I went out and did something fun and recreational. So that's what I did. I went to the hospital. So anyway, that's what a swarm looks like. A baby swarm, I might do 1, and then maybe I'll add 2 or 3, and then maybe I'll add 2 or 3 more, and then maybe 5 more. So it's just a lot less. And I always recommend people practice baby swarming. Giant swarming like this takes a lot of skill, and you need to do this in big accounts. This is for, the 150 quote unquote $5,000 drawdowns. You need a lot of room to do this well, but if you do it well, you can take a lot of risk at the extremes. And, in the first couple of days of the Scalpathon, I did one of these, and somebody said, that was a giant swarm, right? Exactly. And in fact, let's go grab that. Because that's a perfect example of how those will land and what they will look like. So Scalpathon, let's see, Docs Trades. There they are. And we're not asking me. I guess that was a giant swarm with 120 micros. Exactly. Look at the difference of my P&Ls when I did that. And was I doing that all day? No. Why did I do it here? Because it was a perfect spot. I got long and swarmed into a low. And yeah, the MAE was big, but the MAE won't be accurate when you're swarming because you scaled in and out. But look at the size of that, 120 micros, $1,000. And, there were other trades in the day that here was, 16 made $100 or, One, well, that was a flat finger error. Yeah, here's 5 for 37, or so you can see how you scale when it makes sense to do it. This was a really asymmetric low. It was down here on that day. So I said, I have 150 and I got to 120 and I wished I'd done more because I had it exactly right. And I was in that trade for a while. Look at that, 7 minutes. That's unusual for me. Most of them are, 15 seconds, 8 seconds, 30 seconds, but it justified it. And again, this is what risk management is all about. I don't look at that trade and say, oh, wow, I made that much money, so I did it right. That's resulting. I don't do that. I looked at that and said, well, I very deliberately and methodically scaled into an extreme with an appropriate amount of contracts, and I was rewarded for doing that. Very, very different. Okay, let's go back to this for a second. So that's why asymmetry is so important. And that's why understanding the risk models is so important. Does anyone not understand where we're going with all this? And is there anybody, please be honest, is there anybody that still thinks that what I'm teaching here is adding to losers? Because it's not. If I frequently will get, the reason I swarm this is when I put those first 5 on, if I don't like what I see when it gets up here, I won't put on the next 10. No, that was a bad idea. I'll get flat and I haven't taken a lot of risk. But try to do that with one lot, say one lot's an NQ. Try to go in and just trade one lots, no scaling, no swarming. Try to get it right in NQ and see how well you do. I'm a really skilled NQ trader, and I can't get that right. My student mentor now, buddy, video game guy, he doesn't trade one lots in NQ. He trades NQ, and he trades up to 100 NQ. He's a 7-figure trader every year. He will never try a setup without scaling it. It's almost impossible, but he scales really aggressively, really short. And I've seen him work 100 contracts into 10 ticks and then, walk away with a couple $1,000. That's really the art of the short-term range, which we're going to talk a lot more about next week, because this is just as legitimate if you play the range. But again, many of you try this because you're bored during the day and there's no ledge setups, and you get completely burned because you're trying to do it on a range that's not stable. But let's say, this was the initial balance. Oh, crap, that's not a drawing tool. Hang on. Let's say this was the initial balance high, say right here, and this was the initial balance low, and you were doing that, there, and that might work. It might not, but that's a legitimate range. And so are the LRCs. When they're horizontal, you can do the same thing, but you don't just fade the top and buy the bottom. You have to understand under what conditions your tools are telling you that you're wrong. Because again, the purpose of the tools that I use is not where do I put on a trade? It's telling me that when I'm going to do a trade, when I have a trade idea, let's say I'm looking to get short and the advanced decline's been plus 2,000 all day and the tick has not gone below 0. Guess what, Jeff? It's a really bad idea to fade this. You're better off trying to figure out where to go with it. If you can't do that, then sit on your hands. It's that simple. Okay. Any questions about this? I really want, does anybody not understand how this is completely different than, the idea of adding to a loser, that your MAE will be high. But again, if you're discriminating about where to do this, as I just showed you in the P&L, it can take a day where you made a couple $100, $20 at a time. One good trade, there's that Belliafori book, one good trade executed properly with appropriate risk, and you just put up another $1,000 in 7 minutes. And that's why this technique is so good. But if you do it willy-nilly, if you don't do that, what's the worst thing that can happen decision before you start putting the trade on? Then you're going to get run over. And I know it happened to a bunch of people yesterday, and I'm sorry it happened to you, but it's probably the best thing that could happen to you because you'll learn from it. And trust me, I've done this so many times. I've been run over like that. I've done it in front of you a few times with, throwaway accounts or, evals in the Lilu bundles, and I will do that every now and then. It's playing, it's having fun. And if it works, great. It was a YOLO, it worked, but don't assume that you should do that all the time. That's a really stupid conclusion. A smart conclusion is, yeah, this is a really good technique if I use it at the right place. In fact, it's the difference between being profitable and being massively profitable. And that's what my buddy's risk model kept coming back and saying. It said to me, Jeff, Trading anything but NQ or MNQ is just a mistake. The same setup will work better in any other index instrument. So trade YM, trade RTY, or trade NQ. That was the first thing. The second thing was you must scale. If you don't scale, the odds are overwhelming. You can't make it work, no matter how good you are. And then the last thing is with the trailing drawdown, you have to default to taking small profits. You can't let trades be strong winners and then come back. And again, the swarming approach lets you do that because you're instantly taking profits. The second if I put this on up here, the second it starts to trade back into the range, you've watched me do this all week, I'm instantly taking pieces of it off. And the faster I can get a protective stop between the rest of the trade and the price, the better. And if I can do that, then I'm good because I can't lose money. And then I can let the trade do whatever it wants to do. I don't have targets necessarily, but you've seen that I will try to catch a runner when the market's moving quickly in long distances. I will not try to catch runners when that's not happening. I'll put up little close targets and I'll take 6, 8, 10 ticks at a time because that's free $20 bills. Why not? Why take the additional risk of trying to get more out of that when it's just not likely to be there? Think in bets. Okay, let's see. Here's some good comments. Okay. Yes, Ted, that's so important. That's so important. When you have to understand that ledges are not precise points and that it's the range that matters, and you have to do the math of NQ. A pop above the ledge is almost always going to go 10 points or so. And if it's really aggressive, it could go 20 or even more. So if that happened and that scaled you in and then you had to flatten it out, how bad could it get? And if you're doing that math and that number, let's say you're trading the 150,000 account, 5,000 drawdown. If you do that math on a giant swarm and the number is anywhere above $1,000, I get nervous. I will do them because it's necessary. That one that I scaled up that I had the $1,000 winner, that didn't go off sides because I got it right at the edge. But I had a trade 2 weeks ago that was a $10,000 winner, but I had to take it to 1,700 drawdown. This is in the 5,000 drawdown. This is a funded 150K account that I have. And I looked at that and I said, you know what? That's a legitimate decision to go ahead and do that, particularly under the current conditions where I can go get another one of these accounts right now from Lilu for effectively $180 with the one-time fee. So is it worth risking here? Yeah, it's worth risking catastrophic risk. And I did that in one of my Lilus and boom, all of a sudden it's so far above the target, the protective drawdown and all the, where you can, it just boom, it was an instant winner and it was huge. And again, I don't look at that and say, wow, I'm so good. I look at it and say, well, at that moment, the risk was appropriate. And the worst thing that could happen was I've blown that account up, cost me $180 in 10 days to go get another account of that size. Is that worth that money? Today, under those circumstances, at that extreme, that's that asymmetric it was, and it turned into 10 grand. And that's how it will work if you train yourself to think that way. Don't be the guy that scales into a trade like that and then doesn't want to admit you're wrong. Get really good at admitting you're wrong. Practice being wrong. One of the people I'm mentoring had a big problem with big losers a few months ago. We have not seen that problem in almost 2 months. And that's because he focused on that problem. Why was that happening? And how do we not do that? And that problem, it hasn't gone away forever. He'll make the mistake again, even if he doesn't want to, he will. But he knows how he makes that mistake now and how not to make it. And this is so important. And this is a guy who's been working hard at this for 4 years. But that was just like, that was such an epiphany event, even though I've said all this stuff over and over again. But getting to that one flaw in the execution and really focusing on that as an individual and having somebody, standing behind you saying, okay, this is what you do wrong. We've really got to work on this. That's how you get out of that loop and you get to profitability. And that same person just put up a couple more funded accounts this week, and I'm very proud of him. Okay, that could be you guys. That could be anybody. You just have to work at it and not keep making the same mistake over and over again. And it's easy to make this one because you don't want to be wrong. But you know what? If you get to here or here and you're giant swarming and it's just not looking like it might work or it might really blow up, you know what? Nobody ever went broke taking a little bit off. You'd have a couple $100 loss, and that's nothing. You can make that back in the next trade. But if you let it go to a couple of $1,000s and blow up your account, then you got to start over. And that's not worth it unless the setup really, is it SD4 and it's a price rejector and we're at, the ATR of the last 9 years and, and the internals are exactly agreeing. And, if everything is firing on all cylinders, that's an ace king. Throw your money at it. You might be wrong. But if you learn to do that, you'll have ridiculously good winners when you're right. And that's what thinking in bets means. Take advantage of when you're right. Don't be the guy, and this is another common mistake, who can trade really well and make $5 or $10 a trade, but never scale it. That's a really common psychological problem. I've seen that mentoring people too, where they're afraid of success. Having these small successes works in their head, but whenever the risk gets bigger and the reward gets bigger, they can't game it effectively. Their emotions aren't mature enough to do that as a trader, not as a person. So then we focus on that. How do you keep your emotions out of that decision and just make it mechanical? Well, I just showed you. Make it all about the numbers. Pre-accept the loss so that if that catastrophic thing happens, all right, I meant to do that. To be like your cat. When your cat does something it didn't mean to do, but then it has that look on its face, I meant to do. Like when they fall off the table when they're stretching or something.
The Pee Wee Herman effect.
Yeah, exactly. They walk away and the tail flicks. It's like, I meant to do that. I had a cat that had a problem with depth perception. In fact, this is Trader Cat's sister, the orange one at Trader Cat's house. That's Durian the cat. Durian has really poor vision. She's really nearsighted and she has no depth perception. She does this all the time, falls off things, runs into things. And she always has this, her arches up her back and lifts her head up. I meant to do that. It's total attitude. It's catitude. I love it. And you need to do that when you're wrong. You know what? Okay, I accept the risk. I got it. I'll learn from my mistake. Okay, let me see. Back to some of the other questions. Yes, Ted, again, all of your comments are totally knowing how large the area can be. Well, here's another way to think about it. Again, I've mentioned this live in sessions, but here's another metric I do all the time. I take a look at where is ES? So look where ES closed. Okay, here, let me just stretch this out so we can see the prices. Okay. Last price for ES, it's EP for whatever reason in CQG, but 41.49. So that's right on half a whole number, 41.50, which is really significant. It's just human nature. It's a psychological level. So it was like 4,200 or 4,100, big fat whole numbers. So let's say I was looking at this ledge setup in ES or the equivalent in NQ, which I'll get to in a minute. Let's say I was doing that and this price level was like 40.90 or 41.90. There's no way in the world I would try this here because the odds are overwhelming in that instrument's personality. It's going to at least get to 0.0 and then spike up to 2.5, which is the first place I'll even think about fading it because it's ES and it's at a big fat whole number. So for example, in this case, I wouldn't even think about fading this until it broke through 50 and got to 52. And then I would maybe try swarming it. So a lot of times just the price level will give you a clue. Like in MNQ, if it's at 92, I'm not touching a short. The earliest short I will think about if we're at 92 is up at 7. It's got to go through 0.0 and overrun it. Then there might be an opportunity. And the place I really like when it blows 0.0 is 20. Why? Because there's those 20-point extreme, the rubber band stretches out 20 points. When we get to 20 on a sudden sharp move, the odds we're going to retest 10 to 0, big fat whole number 0.0 are so high. Just watch on any given day. It does it over and over and over. You just have to patiently wait for the spot. But sometimes it is justified to start before that spot a little bit. And that's where swarming works. And that's why the model is so effective. It gives you flexibility, but you have to understand, for example, in that same hypothetical I just did, if we got to 20 and 20 doesn't hold and we're still going up, then 30 is a given. And it will always get another 10 points up if it aggressively goes through 20. And then once 30 is in play, it frequently goes and tests 50 again above it. So again, your odds are changing as those levels get taken out. You don't just automatically scale. You have to know your instrument. And if you're doing this in ES, the thing to be aware of is the quarter numbers. And ES loves to play the quarter numbers. Quarter numbers in ES are 0, 2.5, 5, 7.5, and 0 again. Those are the places you should look for inflection. So if this was, right here at like I said, 41.50, I wouldn't even start looking for a short on this until 52.50 and then 55. That would be an interesting spot because that's far enough away in ES speak and that personality of that instrument to be doable. But I still like to do it better in NQ for the reasons I already mentioned. Now, there's another piece of math you should know that's really handy, and it's just the relative movement. On any given day that we're correlated, and today we were well correlated with RTY and NQ leading. This was yesterday. And that's a perfectly trending market. It's above 2% in NQ and RTY. That's a definition of a trend for me. The others are above 1%, but not at 2. So it's not quite a strong trend, but it's strong enough that it's a trend. Okay. So, above 1% is a trend. Above 2 is a decent trend. Above 3 is clearly a strong trend. And after that, still a trend, obviously. But anytime it's between 0 and 1%, it's a rounding error. That's noise. So again, where is it is also useful. And what you can do is you can look at ES and say, okay, ES is up 73 points. So what's the ratio between ES and NQ? That's what I use to game NQ. So right now, use round numbers. What is the ratio between the two right now? It's between what? 3 and 4 to 1, right? So if you take that, and so if I'm looking for, let's say ES was trading at 50, and I'm looking for a move from 52.5, then multiply by that number to get an idea how far NQ might move on the same move. Does everybody get that? It's just a way, and it tends to work pretty well when the market's well correlated. When it's not, I can't do it at all. There won't be any relationship. But most days, there'll be typically a 3 or 4 to 1 to about a 10 to 1 between ES and NQ. And that's a really good little number to help you figure out, besides the common places NQ likes to wait and pause, like 20, is, if it breaks that, where would ES have to go and how many points would that be in NQ? And oftentimes I'll see that and I'll be looking to short 20. I'll do the ES NQ calculation. I'll say, whoa, if ES breaks 50, NQ is going to go to 70. So I'm way too early. And so I won't take the trade. Or I'll take it really, really lightly with a 1+1 or a really baby swarm, throw a micro or 2 on. And, if I get lucky, it'll work. If not, I didn't risk a lot of money. Okay, let's see. Questions. Yeah, exactly, Ted. And this was God, you're perfect straight man for me today. This was the topic I had for Dino for yesterday, and I couldn't do it because I was in the hospital. So I am going to do this topic this Friday, which is the difference between a trader's mindset and an investor's mindset. They're totally different, and you nailed that. Investors like to lower their average price because they're buying value. We're speculators. We're trying to, get an entry and then get out with profit. And it's not about value. It's about movement. Completely different equation. And I'm glad you made that point. And we will talk about that in the Dino session on Friday. It's a really important point. People just ignore it. We are speculators. Our business is professional speculation. We don't care about value other than how it helps us game our speculation. So the whole notion of adding to losers makes no sense because there's no notion of value. Okay. Good point. Thank you. Let's see, JC, there's been a few people complaining to Peter about Jigsaw's MAE reporting. Yeah, there is a problem with it. And it could be better. And again, I just completely ignore it, JC. When I first started doing swarming, that was my first question for my buddy and his PhD. It's like, whoa, these MAEs are like 150. And his reaction to me was, Jeff, you silly boy, how can MAE matter? I said, oh, you're right. I'm scaling. Yeah. He says, so maximum adverse excursion from where? From which entry? And that's the point. And yeah, Jigsaw doesn't do it right on top of that, but I've just ignored it recently. So I don't worry about it. Just, it's a way to kind of relatively measure how good you were. And that's all. No matter how it's always calculated wrong the same way, put it that way. Okay. Yes. Thank you, JC. All right. So we're at 2 hours and 15 minutes here. And let me go back to my slide because I want to see if I made my major points and if there are any questions about them. Because if I accomplish that, this is a perfect place to stop because every setup we do, this applies differently to. If we're working a range, you get a midday range like this over here, you can get really, really aggressive. Under what conditions would you do that? Well, if it looks like this, which it often does, where, the price goes up here and then it goes down here and then it goes, that's why it's the range. And, it'll do this all day in the middle of the day, and absent new information, and if you're careful to look at the calendar and make sure there isn't any likely to come, you can fade really aggressively here, and you can get really aggressive the other way here. As long as you know when you're wrong, you've got to get out of the way because something's changing the range, and a range this strong won't change easily. So something's going on. So you have to let it overextend because that's the nature of regression, but you can't let it overextend too far. You have to get out of the way. And so far, we've tried twice this week, last week, to do good range trading sessions, and we just haven't had the conditions for them. There are several more on the calendar next week. I am going to add some makeup sessions for the one that I missed Friday. So we will have more time on this, but it's important to understand that this applies to two sets of conditions: ledges and ranges. Ranges are harder but doable. Ledges are by far the easiest to game, but you only get ledge breaks when you get them. When I see them, I trade them every single time because they're so lucrative for me. But you can go a whole day and only get 2 ledge breaks. So you got to play ranges or take the day off. So, and again, be very careful of ledge breaks when the market's trending, which is unusual, and it should be obvious. There should be lots of warning signs, internals. We're riding SD2 or SD3 up all day. Hey, guess what? It's trending. Wait till it stops trending. Wait till it goes into ebb and flow. Then there might be a trade. But if it's trending and you cannot join that trend, forget it. Go do something else. It's too hard to trade. Again, contrary to conventional wisdom, the trend is your friend. Nonsense. The trend is your biggest enemy. When we don't have a trend, you can make a fortune in futures. When we have a trend, it's difficult to break even. You have to be very careful. So either trade it very, very precisely or don't trade at all. Okay, so I'm going to go ahead and leave it here for questions, comments. I won't do burning desires yet because I'm not sure I'm done yet, but did I accomplish my objectives? Does everybody understand how you would use this approach? Why there's a 1 + 1, why there's some element of swarming, and how the math is supportive of the idea. Do you not understand that? If you don't, please ask me and to clarify or what's not clicking for you. It's really simple, but again, it's almost counterintuitive. So for a lot of people, it's like fading moves up. They just can't do it. Even though, from an odds point of view, it's a really good thing to do if you do it at the right place. You just got to learn where, and learning the right place takes practice. And guess what? How do you get practice? You make lots of mistakes, and that's how you learn to do it better. So if you're doing it and it's not working, that's good. You're practicing. Keep doing that. I love to put this up here because it's just so true. This is the truest thing on the planet. This right here. This is in a bunch of the streams, but this is from Bruce Lee. Well, it's a Bruce Lee meme, but he actually did say stuff like this. Whoops. Should you be practicing? Whoops, I can't move that over there, can I? Should you be practicing right now? Get rid of the drawings here. Are you the student? Yes, go practice. No, go find the most difficult technique, practice it if you're the teacher. That's me. Is there someone better than you? Yes, keep practicing. Go watch Video Game Guy. Is there someone better than you? No. Find someone better than you, watch him. Okay, you get the point. There's just no excuse not to practice constantly. Because you only get better when you practice. And the more mistakes you make when you're practicing, the better you get. So embrace the idea of being wrong. Being wrong is your friend. Get used to it. It will save you. It will help you make money. Be good at being wrong. Hey. Yes, exactly, Ted. You just need to make a lot more mistakes. You need to practice your mistakes. That's it. I know that sounds, God, almost, comically cliche, but it's true. It really is true. I'm living proof. Amy's living proof. Maria's living proof. David is living proof. Robert is living proof. Brent is living proof. I mean, name anybody in TRG that came in here struggling and now, is funded accounts and withdrawing money because, they've taken to heart that this is a risk management game and nothing else matters. And if you practice that, you get good at it. And, different setups work for different people's personalities, and that's fine. But you can't get around the risk management, no matter what style you're trying to trade. Lee has a really good video. In fact, JVC, could you post is that only TRG when Lee did the risk management structurally. That's only TRG. Where is that in the library? That in risk management?
How did I share? You know what? No, I think I shared the entire risk management section of the library with everybody, in which case that's in there. I'm pretty sure. Let's go look in a browser.
Yeah, I'm going to look real fast and see Scalpathon videos.
I'm trying to remember how I shared that, and I can't remember.
Yeah, here it is right here. So let's see. You put it in. So let me get to the library first and see. I think I don't have access to the Scalpathon. Yeah, I do. Okay. So risk management 1, 2, and 3. Scalpathon Sunday reopen. Okay.
Business of trading, risk management.
Let's see. Is it in there? If not, I'm just wondering
right now.
Yeah, maybe we should put it there. Business of trading.
You know what? It might not be, because I think these are specifically your risk management, and Lee's is in the. Yeah, you know what? Lee's did not make it in here, but it will now. I will go at it right now.
Yeah, Lee's going to share. JVC's going to share this for you guys. Lee did a session on risk management using structural clues, and it's really good, and it will help you. Just understand the game you're playing, whether you choose to do it like that, or more like my approach. They're both legitimate. The only approaches to risk management that are wrong are these R to R approaches. Those just are totally silly. They don't make sense. But Lee's is a good one. So particularly if you're looking to trade more structurally. If you're just looking to price action scalp, the approach that I've suggested here is what I would do. I don't do it the way Lee presented. I've watched it and I know how to do it that way, but that doesn't work for the style of trading that I do. In those cases, price action can, at the very edge of a ledge and a range, can be exactly the opposite of structure and still be a legitimate setup and a good one. And you just have to get used to that. And that's a little bit of the danger of mixing structure too much with price action. There's definitely a value to structure as context for price action. But if there's ever a disagreement between price action and structure, for example, at a spot, Lee won't trade it. And I'll give priority to the price action. That's, and again, it's just a different approach. Like unfinished business.
Sorry, I just realized I was mistaken. I had forgotten what it was actually named. It is in there. It's the one called Statistical Ranges, Execution, and Risk Management.
Oh, okay, cool. So you guys do have access to it. So by all means, watch it. All right. So anyway, it's just a different way of doing it. And, I often, I will take a price action trade. A really clean example of that happens all the time is there's unfinished business at the top of the period. And I'll short it. Lee, that is a rule. He will not short unfinished business. If the price action justifies it, I will. And it works all the time for me, but I get it. Unfinished business says we haven't gone far enough. So that's like any other tool for your context. You have to decide the relative weight you give it for the approach that you take, but you need to understand how it works.
And in fact, that's where we've seen so many times in fishing trips where, you'll fade UB at the high and Lee is looking to buy it to continue long at the exact moment you get out.
Right. Exactly.
So you're just taking opposite sides of the same action.
Same trade. Exactly. Yeah. I mean, I'm buying from Lee and Lee's buying from me. That's literally what's happening.
You guys should probably just trade between each other and do real well.
Yeah. And, new people always look at that and say, you're contradicting each other. No, we're not. You have to understand, if you look at the order flow that is creating unfinished business, it makes sense from a price action point of view. You could fade it because even though the buyers are really aggressive there, the sellers still manage to push them down. Lee looks at that and says, I've got to join those buyers. They're aggressive. And I say, well, the sellers won for the moment, so I'll take it. Again, they're both correct. So it's important that you understand this. All right. Burning desires going once. Are there any questions? I hope this landed for you. I hope this was valuable. It's a hard subject to teach, particularly when people are relatively new, because it's just not used to what they're hearing. Yes, thank you, Ted. We work hard at that. That was an accident that it worked out like that. But we are two very different styles that are complementary and at the same time, educationally complementary, even if you don't do them. And that's a total accident. Lee took my price action workshop in 2019. And then after it was over, he said, we should collaborate because here's my structural stuff. And I said, wow, that's good. So we did. And that's TRG. Here we are. Okay. Any other questions, comments, any burning desires? Is there anyone, please be honest, is anybody that just doesn't understand what I'm talking about and it makes no sense? I mean, are you all on the path to understanding this? Because it's really powerful. And this week, I really want you to kind of keep an eye on how I do it, and I'll try to give specific examples now that you know the setups. And like when we're at a ledge and I'm swarming it, I'll explain the math I'm doing. If I'm wrong, here's how much money I'm risking, and it's up here. Last week I teased that, but I didn't tell you. And what I'm going to do in the live sessions, so previews of coming quizzes, I'm going to ask people to give me the answer. Like right here, I'm short 5. I'm looking at swarming 25. If it gets to 50, how much risk do I have in dollars? That kind of thing. You have to be able to do that quick. What's that?
No, I was going to add, by the way, if anybody is feeling just completely lost and is, afraid to say it, don't worry. It's almost certainly not you. That is totally typical. People come in any of the boot camps we've ever done, any of the condensed intensives that we've done. They are completely overwhelming. I was completely overwhelmed when I first joined TRG and I went through the Chart to Dome workshop. Oh my God, was I lost. Right out of the gate, I was just completely, the first class, literally the very first one, I just no idea what language he was even speaking. I was just completely
That was me.
lost. That was Jeff, exactly. Yeah. So don't feel bad if that's you. On the other side of the equation, we often get people who come through an intensive like this and are convinced, I've got this now. Oh, eureka, I can't lose. And off they go, way overconfident. They don't know what they don't know. And they get taught quickly. The market has a funny way of doing that. And that's also totally normal. Don't feel bad. Don't then throw in the towel and think, oh my God, that stuff, was just nonsense after all. And I can't do this and whatever. This takes an incredible amount of practice. This is going to take, for most people, this is going to take years to display anything you could reasonably call true competence. It might be faster. There's, everyone's different. Sometimes it's less. But I would say from my, what's it been now, 3.5 years, I don't know, something like that in TRG, my observation has been probably the absolute bare minimum for anybody to have a reasonable degree of, I can kind of do this, is 6 months at the absolute bare minimum.
I was just waiting to hear what number you were going to spit out.
Yep. I remember and a year is much more reasonable, frankly.
After I taught this the first time, Amy went out and did 10,000 trades like this over that summer. This was after the workshop and going into TRG. And she came back, she was posting results while she was doing it. And that was one of the best examples I've seen of somebody really aggressively learning a technique, and she got really good at it. She was a 6-monther, but had some trading experience, lots of trading experience. And of new people, the fastest I've seen it really embraced is about a year.
Yep.
Video game guy got it right away, but he had trouble with being confident that he had it right. And even though he got it faster than anybody I've ever seen. But, he's quirky personality. He's got that Asperger's thing going on. And he was like, every time I'd say, yeah, that's exactly right. He'd say, but how do I know that? I'd say, because you're right. I mean, and, but
how do I know 2 + 2 is 4? Because it's 4.
It was his confidence. I just could not, and this was a guy that was a really accomplished professional video gamer. But his personality's quirky. He's like, all right, but I need to prove it to myself more. If I said the same thing, I'd go do it. Just keep doing it. And so, then I checked back in with him about 6 months later. He's like, yeah, you're right. It was working. I put up 175,000 last month. And I was like, 175,000 profit last month? He said, yeah, it was a slow month, but what? All of a sudden, he's like a different guy. It's like, $175,000 of profit is a slow month. This was the guy that didn't want to risk more than $1,000, 2 months earlier. And it was just funny. But, I see that a lot. Once you really get it and you practice it and you say, hey, this is working, and you make a mistake a bunch of times, like JVC said, it doesn't work, but you realize why it didn't work that time, or that was the 1% that it won't work. 1 out of 100, it won't be explainable. It just won't work. That's a black swan. Let it go, So anyway.
And that's something that has been immensely helpful to me in being willing to stick with this and keep at it is, do I still make mistakes? Absolutely. Am I still just completely wrong from time to time? Absolutely. Do I get completely run over and blow up accounts, from time to time? Absolutely. Less frequently than I used to, but absolutely still do it. The important thing is when those things happen, after I take a beat and breathe and get myself to not be quite so pissed off at myself, can I look at what happened and learn from it? And do I understand? Yeah, okay, that's what I did wrong. And as long as I do, because it used to be, oh my God, do I remember, 4 years ago, I vividly remember every single freaking time I was clearly wrong because I just took some big loss or, whatever. I didn't understand why. I couldn't look at it and actually say, there's what I did wrong. I just had no freaking idea. And it was making me crazy. There was somebody I was working with prior to TRG, and that was just a something that he absolutely had no capacity for even identifying or explaining or teaching to or anything. Just nothing. It was, well, you just keep at it, and eventually it will magically just make sense. And that's no good. That's no good. As a teacher, that he could not teach. It was just pure experience, and that, okay, then what do I need you for? Right. So, as long as you are progressing, as long as you're continually improving, even if those improvements seem slower than you want, and they will, it's always slower than we want. Right. But we can't do anything about that. You can't just decide it's going to happen faster. Wrong. Just as long as you can identify, I'm still improving, even if it's incremental, even if it's small, and I wish it was faster, but I am improving. And for me, that has enabled me to stay the course, because I keep improving, even if it's not as fast as I want.
And the math of that is very clear. With math, if you are improving a model, then it's like, it's the speed of light is a good comparison. It's impossible, at least physically in physics, to go the speed of light. Is it possible to go faster than the speed of light? Yes, because you jump over the speed of light.
Which makes no sense.
The speed of light is a limit. If you understand math, a limit is something you can get closer and closer to, but you can never get the thing. It's impossible, because the closer and closer you get to it, the harder and harder it is to get there. And this is the same thing that I trade. I do the same thing. It's like light speed limits. The more extreme it gets, the more aggressive I get. And this is not conventional thinking, but it's really powerful. And I ask you, I'm going to wrap up with one quick last comment with, how many other trading education environments have you been in, where they're teaching a technique and there's just an absurd amount of emphasis on risk management and how to do it? It's rare, because
zero.
It's about, when this crosses that, then you're R to R. And that's not how it works.
Or risk management is, where the recent support and resistance are, and you put your stop there.
I'll put my stop below support. That way support will hold. And again, the math is backwards. Support, in other words, it got bought a bunch of times when we got down there. Every time we go down there again, it's less likely to hold. Not technical analysis says it's more likely. Reality says less likely, for the simple reason supply and demand are never infinite. If there's an aggressive buyer down there, sooner or later, he's going to be out of buying, and we're going to go past him. And that happens all the time. So support and resistance, forget it. They mean nothing. Supply and demand can be useful, but they're not places you automatically trade. You have to look at a reasonable model for managing the risk. And I think if you break it up this way into 3 different models, never try to do one contract. It's just really too hard, even in ES, but certainly in NQ. And, 1+1s are really good practice, and, you're practicing being wrong. And most of the time they work pretty well. And most of the time, you can catch a runner if you execute well. Because you take profits the same way. You put one on, then another one, you take one off, and then the other. So you can catch runners. It's great practice for swarming, but you have to understand, if you're going to swarm, you have to pre-done the math, and the setup has to justify getting more aggressive as it develops. So a trending market is not that. A trending market is going the direction it's planning on. And if you're going to get more and more aggressive as it goes the direction it's going, you're going to get off sides. But if it's sharp, sudden moves that are pulling back into the range, then another sharp, sudden move, that's ideal. And there you want to get aggressive, and you want to take advantage of the math because it's in your favor. Okay, you have an edge. You are thinking in bets. Cool. All right, let's go ahead and we're right at the bottom now. So 2.5 hours. I'm going to take a nap. So burning desires going once. Are there any final questions or comments on anything we talked about? I hope this was helpful. This is critical. I'm going to talk about it all week. We're going to revisit these concepts all week, but really try to just internalize what I've said and really give it some thought, because I think you'll find it's powerful thinking. Okay. I don't see any other comments or questions. Let's wrap it up.
And if anybody thinks of anything after the fact, of course, post it in the pit. We'll be there.
Yes, please do. Thank you, Idris. I appreciate it. I really do. And I'll see you guys, if not tomorrow, I will see you tomorrow for the Sunday reopen. And one thing I posted in the pit, let me just bring it up here. So am I still showing my screen?
You are, no. Yes.
Oh, I am. Okay.
Yes.
Cool. That's weird. All right. I'll let it refresh the share. Then I just reloaded it. Give it a second. There it is. Okay. Anyway, there's a bunch of stuff happening again this week. Earnings, and we have all kinds of good stuff too. We don't have FOMC and we don't have NFP, but remember, those still aren't priced in. Friday's response was a Friday response. I don't know that we've baked in the numbers we got last week. We could see a complete reversal in the reopener Monday. So fasten your seatbelts. I don't think the fun has stopped happening yet. Thank you, Samuel, Ted, appreciate it. JC, Constantine, everybody. Donna, thank you. I appreciate the feedback. Sebastian, have a good rest of the weekend. We'll see you guys later. Thanks, JVC.